If you look at the environment, at least in the U.S., it is pretty encouraging. Stocks reflect that.
If you're printing earnings growth like we're printing, then I think it's going to be hard to keep people out of U.S. equity markets.
Sentiment is probably not overly enthusiastic, but certainly bordering there.
At these valuations and at these levels, it makes it hard to have a positive surprise, and it makes it easier to have a negative surprise.
At the same time, look at equities. That's where I look for opportunities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with the fireworks in the bond market. 410 becomes 420 in just 24 hours. Your 10-year right now, 420.56, up a single basis point at the front end of the curve, back through 4%, 4.04% on a US 2-year. Is it the data? Is it Fed expectations? Or is it the so-called Trump trade? Renmac's Neil Dutter. Financial markets have a lot of Trump priced in. Morgan Stanley's Mike Wilson. Markets may now be offside should Harris win.
Yeah, basically buy the rumor, sell the news. And that's basically what we see, or what a lot of people are saying we're seeing in the bond market. Everyone has said the clearer trade for whoever wins, in particular, more so if Donald Trump wins, is that bond yields will go higher. And that is what is getting priced in at a time where the data is also coming in stronger than expected and supporting that idea that maybe the Fed can't cut as much.
And potentially this is the Trump trade. The fact that next year, as Adam Posen has said to us on this program for months, and also yesterday, that if you have blanket tariffs on day one, that could be highly inflationary. So this time next year, you could have a Fed that potentially is in a hiking cycle. Or is this the fact that the market has actually waken up, that we are 2 weeks away from the U.S. presidential election, and regardless who wins in 14 days, there is going to be a lot of fiscal spending.
The list is long. There's plenty of reasons for this bond market move. We said yesterday it's very difficult to disentangle the politics away from the data, as Lisa mentioned. Upside surprise after upside surprise, particularly what we saw with retail sales just last week. The note I would make this morning, it's global. It's a double-digit move on a US 10-year yield. It's the same in Germany in the last 24 hours. Even in Australia, we saw a 16 basis point move. It's not isolated to the US bond market.
It seems as though there is a global acceptance that maybe people got over their skis when they believed that we're going back to very low rates. Maybe this has to do with the IMF pointing out that there's $100 trillion of debt outstanding, public debt. I don't know. I don't think that that's the case. Some people are attributing that, but they say that every year. There is bigger concern here that this is a market and this is a world that is more inflationary fundamentally. And all of the ideas that we were heading in this perfect disinflationary trend back to 2% are being fundamentally questioned.
Just a touch of pushback from Ian Lingen over at BMO. This is what he had to say. It's difficult to envision an outcome that would warrant another 25 to 30 basis points higher in 10-year yields outside of a GOP sweep. So if you get the GOP sweep, then yes, we start to price in a whole lot more. And we talked about this yesterday. Maybe you could see 50 basis points in just 2 days. Outside of that, bit of pushback from Ian Lincoln.
Basically, the argument being that it's not just tariffs. It has to also come with tax cuts and other types of more stimulative actions that could actually cause earnings to rise. That is the only way that you could get that. Otherwise, people will be pricing in the weakness that probably would come with maybe reduced trade or reduced activity.
But when you look at the congressional map, Democrats have more seats to defend when it comes to the Senate. And then just yesterday, Pennsylvania, which is the bread and butter of this election cycle, Pennsylvania yesterday, Jessica Taylor coming out with a report on the Cook Political Report, moving the Senate seat, Bob Casey's seat, to when he's going against Dave McCormick, to now a toss-up. That was lean Democrat. Also what happened in the past 48 hours. 538, Nate Silver's shop, has moved Pennsylvania for the first time since July. Trump winning that. It is marginal. This is on a knife's edge, but there are little increments that are moving towards the GOP favor.
That's where the momentum is right now. In the equity market, these are the scores for you. On the S&P 500, negative by 0.5%. Underperformance once more on a Russell to small caps. We're down by 0.9% on a Russell this morning. Later, the next stop for the equity market, GM earnings later this hour.
Do we get a different story from the U.S. auto manufacturers versus the European auto manufacturers? I find it fascinating that the Russell 2000 is underperforming. It is the most sensitive to rates going higher. You wonder if auto manufacturers give a similar nod to the fluctuations in their business on the heels of borrowing costs that are more or less accommodative.
Looking for those numbers to drop around about 6:30 Eastern time, so 25 minutes away. Coming up this hour, we'll catch up with Sharon of Goldman Sachs predicting muted future returns in equities, Terry Haines of Pangaea Policy on Elon Musk's $1 million prize, and Reiman of UBS as the bond market begins to price in the so-called Trump trade. We begin this hour with the equity market rally stalling after climbing by more than 20% so far this year. Goldman Sachs says the decade of big S&P 500 returns might be over, writing, "We estimate the S&P 500 will deliver an annualized nominal total return of 3% during the next 10 years and roughly 1% on a real basis." Goldman's Sharon Bell joins us now for more. Sharon, welcome back to the programme. Just walk us through what underpins that view of very muted gains compared to what we have delivered over the last 10 years, looking out another decade.
Yeah, I should say that analysis comes not from my team here in London and Europe, but from our US strategy team, which actually in some ways makes it more compelling because the US equity market has done so incredibly well in the last year, as you point out, up 20% or more. But also in the last decade, it's been an incredibly strong performing market. And yes, their view is that you get lower returns over this next 10 years. And the basis of that view is really two things. One is that valuations are sort of above the 95th percentile at the moment of the historical range. So you're already paying a lot for this market. And the second is it's very concentrated. And that, of course, ups your risk. It ups your idiosyncratic risk particularly. So those two reasons, they think the returns from here will be a bit lower.
Sharon, how does that compare to what you expect for European returns?
Yeah, so European returns, we wouldn't have particularly strong returns for Europe either. Now, Europe's in a bit of a different situation in that valuation is nowhere near as stretched. So I mentioned the US equity market on a basic PE would be above its 95th historical percentile. Europe isn't there. On a PE, Europe is about long-term average at the moment. And that would suggest that European returns could be long-term average, maybe 6, 7, 8% over the next decade. The warning, though, here is that European return on equity isn't as strong as it is in the US, and earnings growth is weak too. We recently downgraded our earnings growth figures for next year for Europe. We only expect really 3 or 4% earnings growth over the next couple of years. We don't really expect a re-rating either. So we don't expect the PE to go up, and the E is only going up 3 or 4%. So that only gives you low returns, really.
Sharon, let's just talk about the next 6 months or so. Right now in the United States, we're talking about how we're pricing in something of a Trump trade in the equity market, in the bond market. Maybe that's part of the reason we've seen yields rise in the United States. And maybe that's part of the reason why we've seen an outperformance in the financials. Is the Trump trade getting priced in for European equities?
Oh, this is a great question. And I do think that it is a Trump trade, partly, which is pushing bond yields up globally, especially in the US. You're starting to see that priced into certain areas of within the stock market as well. I do feel that Trump, and especially any talk about increasing tariffs in the US on global goods coming in, Europe is a big exporter to the US. European companies are global earners. They've benefited in the last couple of decades from large growth in open global economies, and anything that draws back on that, I think, is a bit of a negative for European equities in particular. But we have seen a similar situation in Europe. European banks doing very well, partly because their earnings have been very good, but also they're seen as stocks that perhaps are not so linked to global trade and therefore wouldn't be hit by any increase in tariffs.
You have some specific numbers around how much you could see earnings per share decline in European companies if Trump gets in, if he puts on some of the tariffs that he has pledged to do so. How much of a decline could we see in the overall equity picture in Europe should some of these things go through?
Yeah, absolutely. So if you were to get 10% tariffs on all global goods going into the US, and also some retaliation from Europe too, so this would kind of shrink global trade growth, we think that could take off up to 9% from European earnings. Now, that's huge. I just said before that European earnings in the next couple of years, earnings per share growth, we only expect at sort of low single digits. So if you took off 9% from that, that was already quite a large amount. That all being said, there could be some offsets here. And Trump has also talked about, for instance, tax cuts. And European companies do have a big chunk of their businesses in the US, and they would benefit from lower taxation there. So there could be some offsets, but yes, up to high single digits hit to earnings.
Sharon, what about the fact that just a threat of tariffs, would that in itself hurt European equities, even if Donald Trump did not go through with his plan as he's promising right now?
Yeah, in fact, we think a lot of the damage is done via sentiment and uncertainty. Almost once you know for certain, in many cases, it's already been priced in and some of the damage has already been done. So I would expect even, if you don't actually see the 10% global tariffs, just the concern about it could up the risk premium people apply to Europe, and some concerns about its exposure to global trade. So yes, I think a lot of it would just be a hit to sentiment.
If you're a European equity trader, are you more nervous about what China is doing in terms of their policies, or are you more concerned about the trajectory of the United States?
So I think I would have answered that by saying that I was much more concerned about China a few months ago, because at the time, China, incredibly weak economic growth, clearly overproducing, sending a lot of those goods into Europe, pushing down goods prices in Europe, more competition, particularly for European autos, all very negative, really, for European corporates. But now, with China stimulus coming through, maybe you've cut off the sort of worst case, left-hand tail of incredibly weak China growth into 2025. So I do still worry a little bit about China. I do still feel that you'll see excess production in China of lots of different goods. You will see lower goods prices into Europe, helpful for inflation, bringing that down, but not helpful for corporate profits. For the US, though, I do worry about policy because, of course, we find out in not so long which way policy will likely go. And any tariffs globally, I think hitting global trade is a big concern for Europe.
Hey, Sharon, always great to catch up. Appreciate it. Sharon Bell there of Goldman Sachs on the US versus Europe. Difficult session for Europe. FTSE MIB over in Italy down by more than 1%. Likewise on the IBEX over in Spain, negative by 1.2. If we get that GOP sweep, you have to imagine some of those companies in Europe might be between a bit of a rock and a hard place.
Exactly, especially if you get what Sharon Bell is talking about, something like 9% taken off earnings per share. You just have to wonder whether the approach is the right one when you have these IMF and World Bank meetings, and you have all these world leaders coming down decrying the deficit. Should there be a little more focus on maybe how they're going to support some of the industries in their region if that ultimately is one of the big challenges?
Yeah, more headlines about innovation and maybe not finding tech firms based in the US.
Well, I was looking, for example, at some of the tax rates, and they're going up in Europe, and they're expected to either go down or stay the same in the US. You start looking at potential for innovation. You look at all of these things, and you start wondering, yeah, I get the deficit. I am a big deficit warrior. I say, oi, the deficit. However, there is also room for what are you doing on the other side, especially if you have some structural issues in certain key industries.
European equities softer this morning. Here in the United States, S&P 500 futures negative by about 0.5%. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares of SAP rising nearly 3% in the German trade. Europe's biggest software company reported a jump in third quarter cloud sales. It's working to move customers to its AI tools and analytics. Cloud revenue rose nearly $5 billion. That's a 25% increase from a year earlier. Its cloud backlog rose to over $16 billion. BHP has gone to trial in London over a 2015 dam collapse at a Brazilian iron ore mine. BHP is accused of trying to avoid paying billions of dollars in compensation to those affected. The London case will test just how far English courts are willing to punish firms over environmental disasters that happen far away. More than 620,000 Brazilians are seeking around $47 billion. Elon Musk and Tesla are being sued by Alcon Entertainment. The studio says that Tesla used imagery inspired by the 2017 movie Blade Runner 2049 at its recent robo-taxi event after permission was denied. Alcon also alleges that Tesla didn't reach out for permission until the day of the event. Musk, Tesla, Warner Brothers Discovery, which hosted the event, are all listed as defendants. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the program, Election Day, 2 weeks away.
I absolutely believe we must raise minimum wage and that hardworking Americans, whether they're working at McDonald's or anywhere else, should have at least the ability to be able to take care of their family and take care of themselves in a way that allows them to actually be able to sustain their needs.
That conversation just around the corner, live from New York City this morning. Good morning. Equity 20 futures negative here by 0.4% on the S&P 500. Yields just a little bit higher. Once again, 420 on a US 10-year. Under surveillance this morning, election day, just 2 weeks away.
My opponent, Donald Trump, does not believe we should raise minimum wage. And I think everyone knows that the current federal minimum wage is $7.25 an hour. I absolutely believe we must raise minimum wage, and that hardworking Americans, whether they're working at McDonald's or anywhere else, should have at least the ability to be able to take care of their family and take care of themselves in a way that allows them to actually be able to sustain their needs.
So here's the latest. Kamala Harris and Donald Trump doubling down on swing state voters. The vice president stopping in Rust Belt states Michigan, Pennsylvania and Wisconsin, while Trump is making the rounds in North Carolina. The polling still incredibly tight. USA Today, Suffolk University, showing Harris leading by just 1 point over Trump nationally. Bloomberg's Mike Shepard joins us now for more. Mike, welcome to the program, sir. Let's talk about where this campaigning is taking place and why the former president is spending so much time in North Carolina.
Well, John, I'm glad you brought up the Tar Heel State, because Donald Trump is now devoting a lot of resources there. Over the past 2 days, he will be making 4 appearances within about a 48-hour span, and that just signifies how important this is to his campaign. We talk a lot about the Democratic blue wall of northern industrial states, but North Carolina is shaping up as something of a red wall for Trump. He won the state in 2016 and again in 2020, but in the last election against Joe Biden, the margin was pretty tight when it came to his victory there. And Democrats are seeing the state as a potential pickup opportunity. So Trump has been crisscrossing the state over the past 2 days, and he has a rally scheduled there tonight where he will try to drive home a couple of key points. One, of course, is on the economy that we have heard again and again, that if you don't like the economy now, why are you voting for Kamala Harris to bring back more of the same? But he's also seizing on the recent natural disaster in western North Carolina as a way to highlight what he calls incompetence by the federal government. And that was something he raised yesterday during his visit to the Asheville area.
Shep, already today, 15 million people have voted in early voting. But when it comes to a state like North Carolina and some of these other southeastern states that were ravaged by the hurricanes, how hard has it been for people to get out and vote?
Well, it's a great question, Anne-Marie. The storm had such a devastating effect on the region in terms of really just disrupting people's ability to access basic needs, to be able to get to work. They've lost their homes, they've lost their livelihoods, and hundreds of people lost their lives in these disasters. And so voting, you would think, comes after all those basics. But many people have been really trying to rally to get to polling places. We've seen lines in Asheville that were already very long. And the state is making some accommodations so that people can get absentee ballots sent to their temporary addresses if they've been displaced. And voters will be allowed to cast ballots anywhere in the state as needed if they've been displaced. So they've made some accommodations, but it will be difficult. And it may also complicate how the vote tally is conducted toward the end. So this is something we're paying close attention to. And it's important to note that while the former president has been raising concerns and allegations and accusations about the delivery of aid in this region, state and local officials have generally praised the federal government, and they have faulted some of the disinformation and false claims that the former president and his allies have been making about how FEMA and the Biden administration have been performing, too.
Shep, appreciate the clarity, sir. Down in the nation's capital, Bloomberg's Michael Shepard with the latest from Washington, D.C. To continue the conversation, Terry Haines of Pangaea Policy joins us now. Terry, welcome to the programme. This market and some market participants believe that this bond market is starting to lean towards a Donald Trump win. Polls are still incredibly tight. How do you see things?
Well, I'm still of the view that Harris squeaks out a win, but what you've got with Harris is a combination of a split political Congress with a Republican Senate and a Democratic House, again with bare majorities. So you've got kind of a remixed status quo on policy, frankly, and I think. This is the time of year where in the markets, people get way over their skis on a political result. In 2016, the way over the skis was all about a completely blue Washington, and we know how that turned out. So I'd urge people to pull back and take a look at what's actually happening on the ground.
Well, let's pull back and look at what's actually happening on the ground in Pennsylvania, Terry. 538 Nate Silver now has Trump in the lead there, the first time since July. And the Cook Political Report moved the Senate race there to a toss-up. Prior, it was lean Democrat. Those are not good signs for Kamala Harris in a state that is a must-win for Democrats.
No, they're not. But I think what that is all about is about polling numbers, and then we should take those seriously, but not literally, as a friend of mine once said. And we should also look at things that are intangibles. And I think the intangibles, like the turnout machines and the ability to bring people out, is what gets Harris to prevail barely in Pennsylvania. 2016. Democrats got surprised. 2020, they didn't get surprised and they barely won. The Harris campaign has had a ground game that was inherited from the Biden campaign, and I think, frankly, that's going to be just enough to have it win there.
Terry, John brought up what Neil Dutta said, which is basically a lot of Trump is priced in. He goes on to say this is not like 2016 when predicting markets had him under 20% in the week before the election. Today, Trump is above 50% across a variety of different polling averages and betting markets. Why don't you agree with what is currently being priced in the polling and betting markets? What are these polls getting wrong?
I just think what the polling shows is a very, very tight race. So it's really down to turnout. That's kind of a trope, but it's also true when you've got a neck and neck race. And I think that the intangibles on the Harris side probably get her to enough votes to win. Frankly, the way to put this in Pennsylvania, for example, since you were using this as an example, is that the turnout in the Philly and the blue suburbs kind of overwhelm the rest of the state, the vast majority of the rest of the state, which is red. Trump's trying everything he can to pump up kind of red turnout, particularly people that don't come out and vote a whole lot. But my own bet is that methodical turnout is going to do better than kind of scattershot work at the very, very end.
Terry, is there anything in particular that you have your eye on that could potentially change the race in a more material way in the next 2 weeks?
The next 2 weeks, no, I don't think there's anything real serious. Markets will whip themselves up about jobs reports and a whole bunch of other things. But, fundamentally, a lot of people like to talk about these elections like technicians. One issue or another is going to matter and all the rest. And, in reality, 70% of these folks will already have voted before Election Day. And the people that are holding themselves back aren't thinking about one issue or the other. They're thinking about, who do I want who do I want running the country in the next 4 years? Is this Harris person really okay? Am I willing to put up with another 4 years of Trump? Do I like 4 more years of Trump? What am I going to be doing? That's the kind of basic, people like to call these things existential choices, but that's the kind of basic choice that undecided voters are looking for. And, that's not easily charted.
Terry. It's good to hear from you. Terry Haines there of Pangaea Policy. The closing arguments on a campaign trail through the next 2 weeks. The former President Donald Trump leaning into a very simple one. Is your life better now than it was 4 years ago? And we heard that a few times.
And this was the line that he should have used at the debate, but he waited to the very end of the debate to use, and now he's trying to hammer this home. It's 14 days. What you do see is them going to the swing states. They have to go to where the constituents are they want to come out and vote. Yesterday, where was Kamala Harris? The entire blue wall. With who? Liz Cheney. They think that this is potentially someone that could tell Republicans, it's okay, you can vote for her. What I find fascinating is that then you had Tim Walz on the Daily Show with Jon Stewart saying, I think Liz Cheney and Dick Cheney give permission to those folks who want to find a reason to do the right thing. We're not going to take their foreign policy, though, decisions and implement those. Well, if you're a Republican that is, say, a Nikki Haley supporter, that's the reason why you would maybe want them to take their foreign policy.
What are you voting for?
Exactly.
Doubling down on swing state voters over the next 2 weeks. Equity futures on the S&P 500 near session lows. We're negative by 0.4%. Up next on the program, earnings from GM and a reaction from Bloomberg's Craig Trudell. From New York, this is Bloomberg. Equity futures just a little bit lower. We're negative by 0.5% on the S&P, down 0.6 on the Nasdaq 100. On a Russell 2000, down by 0.8%. This equity market needing to process what's happening in the bond market, so switch up the board. On a 2-year, 10-year, 30-year, yields higher, much higher through yesterday's session. Just a little bit higher this morning, up almost a basis point on a 10-year, 420.17. On a 2-year, up a single basis point to 4.04%. The focus on the earnings this morning, GM just dropping, and it's some good news for General Motors.
Yeah, when you take a look at earnings per share for the third quarter, it's $2.96 versus the estimate of $2.45. But you look through, and it's a raise, talking about $10 to $10.50 for the full year adjusted earnings per share. That is in the higher range of where they had originally been expected to come in. What is amazing to this is how different the tone is from European auto manufacturers. They are talking about how even in China, sales are improving from the second quarter. They're working through their inventories. In the U.S., they are cutting costs. They are increasing their revenues from EV production, and they are actually on track to generate a profit from their electric vehicles. This is a very different story than the Volkswagens and the BMWs.
GM right now higher by 3.5%, call it 4% in the pre-market. Let's turn to our reporter out of London, Bloomberg's Craig Trudell. Craig, walk me through what GM is getting right and what everyone else seems to be getting wrong.
Yeah, I think the EV transition, they have not been without their bumps in this process, right? We for some time, GM was trying to build up its own sort of dedicated EV and battery platform called Ultium. That didn't go particularly smoothly. Recently, the company has brought in a longtime former Tesla executive to run that side of the business, and he's making some major changes. I think the amount of product activity on the EV side is really ramping up. Next year is going to be a very busy year for them. And I do think that it's interesting that we're seeing sort of, a reduction of losses on the EV side as they've really continued to just hit their marks and execute extremely well on the sort of old line business of, making big pickups and SUVs that have long made them a lot of money and continue to be the main source of their profits.
Craig, it's not just the product mix, which is noteworthy this morning. It's also the regional breakdown. Lisa mentioned this quote from China, on China. In China, sales improved from the second quarter. Dealer inventory fell sharply. What do you think is going on in the world's second largest economy?
I think GM is really struggling, like some of the European names mentioned, in China, but I think they are trying to really sort of get their act together and recalibrate what that business is going to be going forward. And I think in broad strokes, what they want to do is stop competing in this sort of, very competitive, middle market there. They have a really strong business of low-priced vehicles, a business called Wuling, that does quite well, and they want to try and move up market. That is not necessarily going to be without challenges. It probably means lower volumes there long term. But I think the outlook for international car makers in China is really messy given the sort of geopolitical forces. So it probably makes sense to sort of view the future in China as smaller and more strategic, and that seems to be where Mary Barra's head's at.
Craig, our perception, or my perception, is that European auto manufacturers' hands are more shackled to the idea that a significant bulk of their sales stem from China, and that they're really tied to that area at the same time that the walls aren't as high for Chinese vehicles coming into the Euro region. In the U.S., is it really fundamentally different, and is that part of why they can make bold moves and maybe make incremental gains since it's not a major component of their overall revenues?
I think that's a spot on read. I also think that, here in Europe, you don't have the sort of full-size pickup market and full-size SUVs that do make GM and Ford so much money. And so, you have much more of your business in the sort of, smaller car, mid-size car segments. And while there has been some, traction in terms of, more SUVs that are higher margin, and these companies aren't without high margin business also in the luxury space. Even a sort of full line manufacturer like VW makes quite a bit of money selling Audis and Porsches. It is still just more of a slog in those sort of mass market segments where the Chinese manufacturers have just made a remarkable turn just in the last half decade or so of really being competitive in those spaces and making life really difficult if you're a European manufacturer.
Craig, how much is this truly a sign that GM is about to begin a new cycle of real growth? And how much is this them managing costs more effectively, them already right-sizing certain businesses? And frankly, they still face some of the upward shift to potentially higher labor costs and a real toggle at a time of transitioning technology that comes with production.
Yeah, I think it is more so the latter of strong execution and sort of keeping your business in order, as opposed to sort of being able to count on those go-go days in China ever coming back. I don't think that GM is necessarily even counting on EVs being the way that they make money in the near future. They're talking about reducing losses there and getting to where they're on a more equal footing with the rest of the business going forward, as opposed to that being where they make a big source of their earnings anytime soon. I do think also a key factor here is policy and the manufacturing tax credits passed by the Biden administration, and what the sort of outlook is for that business going forward, because there are potential for major swings in the way forward for the U.S. market in terms of whether or not stricter CO2 emissions limits stay in place that the Biden administration has implemented, whether or not the support is there for this EV and battery transition. It has not been without its issues, but GM is expecting to generate quite a bit of money from manufacturing tax credits, because they have these battery joint ventures in the U.S. that are spooling up. It would be potentially a significant disruption if that support goes away, and if the CO2 limits that have been put into place are eased back down, as happened during the first Trump administration.
Craig, that's exactly what I wanted to ask you. What does the future of their EV market look like? How many EVs they can potentially produce, and how profitable they would be if those subsidies start to dry up in potentially a red wave, maybe less so of Trump's presidency, but a red wave where they would actually have to change the law of the Inflation Reduction Act?
Yeah, I think we've seen a somewhat universal dialing back of, we need to recalibrate our expectations in terms of EV and battery production. We've seen that pretty universally across, the major automakers, GM and Ford in particular. I think we're sort of out front there. But I think if you look at those two companies and compare them, the amount of EV production in the works, if you're GM, is significantly more than Ford. They have a lot more products coming to market, already in market. And, so the potential for a 180, I think, if you have to look at just those two businesses, it would be much more disruptive for General Motors than it would be for Ford if that support were to be dialed back.
Craig, appreciate the update. As always, sir, their stock is up by 3% in the pre-market. It's a beat and it's a raise. And it's a big thank you to the gas-powered GMC Yukon and Chevy Silverado in many ways.
Well, basically, this is a country in the United States where people like their trucks. The trucks tend to be higher margin businesses, and they've leaned into that. They are still working on their EV plans, but it's less dependent on that type of transition than, say, going out west in your pickup.
The US is doing better. Europe, not so much. Under surveillance this morning, car sales in Europe falling in September for the first consecutive monthly decline in more than 2 years. The European Automobile Manufacturers Association saying new car registrations fell 4.2% compared to a year ago. Stellantis posting one of the biggest drops. Check this out. Registrations plummeting 26%.
So is this an issue of execution? Is this issue of a structural shift, or is it both? And that's really what it seems like this company has been grappling with as they try to rejigger their entire executive framework. How do they come up with a plan, though? When we talked with Carlos Tavares, he basically said they need to come up with some sort of structure of incentivizing people to buy, of making it cheaper for them to actually manufacture in the Euro region. Otherwise, they are going to be permanently at a competitive disadvantage.
Europe has too much capacity. And arguably, maybe the world has too much capacity. And if the walls go up stateside following the election in this country, then there's only going to be one region that has to eat that capacity, even with those tariffs. And it goes beyond just the automobiles, by the way. So if you're going to get an inflationary shock, and this is a bit of a tangent, I know, just away from the car makers for a moment. If you believe we would get an inflationary shock from a Trump presidency in this country and a GOP sweep, you'd have to imagine we'll have somewhat of a disinflationary shock in the rest of the world, because the rest of the world has to eat what China's provided right now.
This goes to Peter Scheer's point, and he has been incredibly articulate on this. China's game plan to get them out of the economic malaise that they've been in is to overproduce and to supply the rest of the world, to be the manufacturer of the entire world. They've created the goods. Where are they going to go? If the walls are up for the U.S., they got to go somewhere else, and that means maybe disinflation, but at the expense of industries that are homegrown.
Which is why we see Europe either deciding they're going to put the walls up, and there's negotiations about tariffs in terms of China dumping on their market, or places like Hungary are inviting Chinese auto manufacturers in to at least build in Europe. Because why? They need to, at the end of the day, also save jobs, which is the issue that VW is going to have if they want to decide to start shutting factory doors.
I saw a similar thing in Italy as well, with Giorgia Meloni, the Prime Minister there. Let's get you the latest on the Fed speak. I do not envy being a monetary policy maker right now through 2025. It is really, really difficult. San Francisco Fed President Mary Daly saying she doesn't see any reason to stop cutting interest rates for now. Other Fed officials signal they favour a slower pace of rate reductions, including Laurie Logan, Neil Kashkari and Jeff Smear, and then things could change all over again in about 2 weeks' time.
The truth is, they all are saying the same thing, just from different angles, because even Mary Daly only sees 1 or 2 more rate cuts this year of 25 basis points. Neil Kashkari talking about how he wants to have 25 or smaller rate cuts rather than the outsized one that they began the cycle with. This is all basically different sides of this idea that we don't want to make bold moves. We're moving incrementally, but we still are well above the neutral rate. This, of course, goes back to what is neutral, how far can they cut, et cetera, et cetera. I feel like they're all dancing on the head of a pin at a time where we're all just vulnerable to economic data, and that, I think, is what we're feeling from their commentary.
Which is why the jobs report is going to be so important. That comes before the next Fed decision. It comes before the U.S. election. And what Mary Daly said we already know that we're on a path towards 2% when it comes to inflation. She said, I don't want to see the labor market slow further. So you had that exceptional labor market report that obviously start to spur up these concerns about maybe the Fed cut too much. Maybe the Fed doesn't need to cut anymore. But if we get a really weaker labor report, potentially then we'll see it swing in the other direction.
November 1. 9 estimates are in our survey. Sneak peek, 140 is the estimate. 140K. I'll give you the high and the low at the moment. The high is 160. The low at the moment is 75. 75 comes from Deutsche Bank, by the way. Governor Waller said 100K. The hurricane impact, some of the strike impact, you can take 100K off this number, maybe. I've seen estimates from anywhere between 40 to 100K. To see Deutsche Bank down at 75, you'd have to imagine that call from Brett Ryan is based largely on the hurricane disruption.
Which, to a certain degree, can be, I don't want to say discounted, but won't necessarily be seen as a trend of massive deceleration in the labor market. Again, it gets messy, so good luck. Have fun. And I think that's the reason why a lot of them, Mary Daly in particular, was saying, ultimately, she's looking past this. It's not her major data point. She's looking at other factors, like some of the surveys and discussions, the qualitative data.
The Beige Book, things like that.
Exactly.
Yes,
that's the reason why it actually really matters.
Beige Book a little bit later this week, tomorrow. Yeah, you excited for that?
Oh, yeah.
I believe it's Wednesday, right?
Yeah, I believe it's Wednesday. For a second, I thought maybe it's today. But then I thought, no, 20-year auction, Beige Book. It's a really exciting.
That's how you think about things.
Yeah, basically.
How Bramo's brain works. Yeah. All right, let's get the latest from the Middle East. Secretary of State Antony Blinken back in the Middle East, meeting with Israeli Prime Minister Benjamin Netanyahu, as the Defense Minister is going to be meeting with him later today as well. The US hoping Israel's killing of Hamas leader Yahya Sinwar just last week may open the way for a ceasefire. Very little sign of that just yet.
Very little sign of that. And you have to think they are sending Blinken into the region now, his 11th trip to the region since that terrorist attack more than a year ago now on October 7, 2023, because they want to try to slow things down. We are 2 weeks out from the U.S. presidential election. Does anyone actually think we're going to get a ceasefire before then? No. But potentially what they don't want to see is they don't want to see the escalations get even hotter. But already overnight, what did we see? Israeli overnight was attacking near a hospital. It was targeting what it said a terrorist target. Hezbollah then launched missiles back towards Tel Aviv. We already see the escalation every single day.
And the oil market has been incredibly volatile. Losses of close to 8% just last week, bouncing back this week, just grinding higher again in today's session, up by 0.9%, approaching 75 on Brent. On WTI, up by a similar amount to about 71.22. With an update on stories elsewhere this morning, with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Early voting is underway in states across the country, and votes are pouring in. More than 15 million votes have already been cast nationally. Democratic voters are leading the totals, but Republicans are not far behind. 46% of the ballots cast have been from registered Democrats, 36% from Republicans. An activist investor is urging the Cheesecake Factory to break up. The Wall Street Journal reporting that JCP has built a 2% stake in that chain. The Houston-based firm is urging executives to spin off 3 of the smaller restaurant brands into smaller companies. According to people familiar with the matter, JCP told Cheesecake Factory it would be willing to inject capital in the spun-off entity to help it grow. Live Golf is teeing off in India. Sky News reporting that Live CEO Greg Norman agreed to a deal that will see a tournament held at the DLF Golf and Country Club near New Delhi next February. Sources said the agreement, which has yet to be signed, would see the venue hosting an Live International Series featuring 148 international golfers alongside 16 Live League golfers. And that's your brief, John.
Danny, thank you. Still so sad that golf is this divided. Up next on the program, deciphering the Trump trade.
If one candidate is talking about tariffs and another candidate is talking about higher taxes, they're both a tax. What does that mean to me as an investor? Inflation. It's not so much just a Trump trade or not.
Some big moves in this bond market. We'll break them down. Up next on the program from New York, this is Bloomberg. The morning of that interest rate cut from the Federal Reserve back in September, when they dropped 50 basis points, the 10-year yield opened up at 3.64. Look at things now. 4.20, a move of 50 basis points plus on a 10-year yield. 4.20.76 and up another single basis point this morning. Under surveillance this morning, deciphering the Trump trade.
If one candidate is talking about tariffs and another candidate is talking about higher taxes, they're both a tax. What does that mean to me as an investor? Inflation. And that's one of the reasons why I think you see yields starting to move higher. It's not so much just a Trump trade or not. All of this is putting upward pressure on rates. And I think this is something that we're going to have to deal with as we move into the next months ahead.
So here's the latest. Bond yields surging to their highest levels since July as traders pair bets on Fed rate cuts and begin to price in expectations for the U.S. election. Kurt Reiman of UBS assigning a 45% chance Harris wins with a split Congress, writing a Democratic sweep would likely be the most negative outcome for equities. Markets would likely cheer a Republican sweep for its lower taxes and lighter regulation. But this could be partially offset by concerns about the costs and inflation impacts. I'm pleased to say that in the studio, Kurt joins us now. Kurt, good morning to you.
It's good to be with you.
You are in a fantastic seat because you sit on both the fixed income side of things and you have to deal with the politics in this election over the next few weeks. Can you tell us how much of an election impact you think we're already seeing in fixed income?
I think there may be some of an impact because it's not just happening in the bond market. You're seeing it in some of the sectors within the stock market that would tend to favor a Trump victory. And his numbers have improved in the polls recently. But I think the bond market's also telling another story, which is that the front end of the yield curve was pricing in more aggressive Fed rate cuts than we thought was reasonable. But also the growth backdrop has improved. So we've seen a bit of a bear flattening of the curve over the past, call it, month or so. I think that move higher in yields is more about a growth pickup than it is about anything related to necessarily concerns about inflation. So if we get inflation leading to higher rates, then I'm concerned. But at a 4.15, 4.20 yield on the 10-year, that's looking more attractive. Yeah.
So you don't think actually what the bond market is saying is Trump winning?
I think this is much more about the growth backdrop. I think the election outcome is very much a secondary factor because let's face it, the polls are still very tight. This can go either way. The battleground states, 4 of them are within a percentage point. So this is not an election that has been decided. We still have, as you know, a couple of weeks to go. Because of that, it would seem unlikely that the bond market and the equity market would be pricing in today a more complete picture of how this election is going to unfold.
But as Jim Caron was saying, whether or not it's Harris or Trump, it could be inflationary. With Trump, you get tariffs, and with Harris, you get higher corporate taxes. Both of these could be very inflationary. Also, there's going to be tax cut for people like in the middle income. Why wouldn't the bond market just be pricing in that environment?
I think that's missing a big element of what we're seeing unfold in D.C. over the next administration, or at least the next 2 years, and that is constraints on government. So you think about the Senate and the House. If you get a united government, you are going to have very narrow majorities. And the prospects for divided government under Harris are quite high because the Senate looks very likely to shift Republican. So when it comes to all of the policy prescriptions that have been put out on the campaign trail, not a lot of them are going to get done. I think when it comes to personal income tax cuts and extending those, we'll probably get most, if not all of them. But on the corporate tax side, when you think about the current state of deficits and the debt load, adding another tax cut in the case of Trump is going to be hard to do with the fiscal hawks. And if you have divided government under Harris, well, I mean, then that's just a non-starter.
So if you don't think that what we're seeing right now in the bond market is a Trump trade, are you saying that the market is not going to price in some of those fears of higher deficits, higher inflation, et cetera, in the direct aftermath if Trump does win? In other words, could you see yields climbing quite significantly in the immediate aftermath?
Yes, there's going to be the knee-jerk reaction, as there always is. We could get a bear steepener of the yield curve in the event of a Trump victory. We could get the dollar appreciating quite a bit, even though it's already very expensive. So you think about some of those reactions, yes, but then I think the market's going to get back to what is the foundational elements of the markets that we're seeing today, which is that the economy is strong, that the Fed is cutting interest rates into the end of next year and maybe even further than that. We've had strong earnings growth. We think earnings growth is going to remain strong next year. Where are the concerns on a Trump victory? Yeah, sure, it's on tariffs. But then the question is how strong will they be? They get more stagflationary the more that tariffs are raised, but then that has sort of cycles back on itself. If it becomes inflationary and bad for the economy, then maybe that'll be a signal to the administration that they want to do a deal or make some kind of an adjustment.
Terry Wiseman was talking about how his key tell will be if the dollar weakens in tandem with yields going higher after this election. Do you see that as a possibility if international investors get concerned about the U.S. deficit?
Yeah, I mean, I still think that deficits and debt are more of a secondary factor. They're not showing up in influencing where the bond market is headed. The bond market's principal direction is coming from the macroeconomy. It's coming from the decline in inflation rates, the sort of trend rate of growth in the economy, or if you will, nominal GDP. I mean, we're sort of getting back there. I also think, though, that it's possible that the dollar could weaken, very likely, because it is so strong right now. So the longer term view and what we tell our clients is keep with the long term, keep the focus on your strategic portfolio weights, focus on, and make some tactical trades if you can that you think make sense. But for the most part, hew towards your strategic asset allocation.
Kurt, this was great. We've got to do it again soon. It's good to see you.
Look forward to it.
And before the election, 2 weeks to go. Kurt, thank you. Kurt Reiman there of UBS. Coming up next in the second hour of Bloomberg Surveillance, Cameron Dawson of NewEdge Wealth, Mary Allen Klass of Bloomberg Opinion, Torsten Slok of Apollo, and Chris Marinac of Janney Montgomery Scott from New York City. This is Bloomberg.
If the micro is murky, we're going to focus on the macro.
The base case for us is still an economy that just softens up a little bit, doesn't go into recession, not even close, as inflation continues to move back down towards target.
What's really, truly in the driving seat is the fact that the economy is resilient, and that has been on full display.
That is not the type of economy that typically would get significant easing ahead, but the Fed is committed and the direction is clear.
Also now calls into question the need for additional rate cuts, at least in the near term, as we look out to that November policy decision.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with a lively debate about this right here. Bond yields in America climbing by double-digit basis points in yesterday's session. The 10-year moves from 410 to 420, 420.56, and up another single basis point this morning. Likewise, at the front end of the curve, up another single basis point, north of 4%, 4.04%. The debate around the table, is it the data or the politics?
We've seen a lot of better than expected data, including earnings that have beat expectations, and companies have been rewarded for that. If you look at the underpinnings of this yield move, a significant portion of it has come from real yields, so adjusted for inflation. They have risen from about 1.5% to almost 1.9% on the 10-year. If you take a look at how much is from inflation expectations, a little bit, but basically this is basically a commentary on people demanding a higher premium to own longer-term U.S. bonds in the face of a whole host of uncertainties.
And maybe right now, when you look at it, we don't know the outcome of the U.S. election. It could be about growth. What's the Fed's path forward? But if you do look at the politics of it, other parts of the market are pricing in a Trump trade. And for some people, they're looking at the betting markets, looking at the financial markets, and they're saying that could be the outcome. We're getting ahead of it. What does a Trump trade mean? Basically, higher inflation certainly next year. Adam Posen has talked about this, and potentially the Fed then hiking. Or you just look at this and you say, regardless of who wins, there's going to be a lot more fiscal spending.
So let's get beyond bonds, because it's not just bonds, it's financials too. So we had a rally on the banks. You can sit here and say, well, it's going to be a lighter touch on regulation if it's Donald Trump. Sure, possibly. But the difficulty you've got with the financials is the same difficulty you have with the bond market. It's very difficult to unpack what is about the fundamentals and what is about just the guessing game of the politics and the election that's 2 weeks away. Likewise on the financials, the earnings were decent. For the bond market, the data was good. Which one is it, the politics or the data or the earnings? I don't know. Maybe it's a mix of all of the above.
How about just yes? I mean, basically, this is the reason why people feel like they're staring into sun. Just to keep repeating Lori Calvasina over at RBC Capital Markets, there is a sense that it's very hard to distinguish valuations from the reality on the ground. It is something very hard for people to bet against, considering that it is a two-pronged type of wager.
Goldman Sachs came out with a note last night, and they spoke to two individuals that I think are really important for the Democrats and the Republicans. Kevin Hassett, the former chairman of the Council of Economic Advisors under Trump, and then Jared Bernstein, the current individual. Kevin Hassett, extending the Tax Cuts and Jobs Act and relaxing scrutiny regulation should be the priorities and could be enacted quite quickly. Then he goes into a host of reasons why there should be tariffs. Jared Bernstein, I would prioritize the two big pieces of unfinished business, affordable housing and childcare, which I consider to be pretty existential market failures. What does this mean? This is a ton of fiscal spending coming out of Washington, honestly, regardless of who wins.
Equity futures right now on the S&P 500 pulling back in the face of this move in the bond market. Stocks are down across the board. On the S&P 500, we are negative by about 0.5%, down much more. On the Russell, the small caps down by 0.7%. Bit of outperformance, GM. A beat and a raise. General Motors in the pre-market, Lisa, up by 1.4%.
Not only did they beat the third quarter earnings per share, but as you mentioned, they really put out there the full year projection that was at the higher end of estimates between $10 and $10.50 a share. A real question here about how different the U.S. auto manufacturers are from European ones. Is it because they are more isolated from China, or is this not a rejection, but their own take on the EV transition, the pace that they want to go at, and how much they consider that to be a potentially profitable area versus big trucks?
More on that story a little bit later. Very big trucks, very profitable big trucks.
That's right.
Coming up this hour, Cameron Dawson of NewEdge Wealth with Treasury yields at the highest level since July. Mary Ellen Klass of Bloomberg Opinion on why one-party control is steamrolling voters. And Torsten Slok of Apollo explaining why he's still in the no-landing camp. We begin this hour with Treasury yields inching higher as investors reassess the outlook for monetary policy and fiscal fears grow just 2 weeks out from the election. Cameron Dawson of NewEdge Wealth saying 10-year yields are moving higher because economic surprises and Trump Republican sweep odds are rising. We would not be surprised to see a near-term jump in yields that could be reversed post the election. Cameron joins us now for more. Cameron, welcome to the programme. Let's do the lessons of the previous cycles. What is the lesson from 2016 with regards to some of the moves we're seeing right now?
So It's a really important one, which is that after the surprise election of Trump in 2016, what you saw was an over 100 basis points jump in the 10-year yield in under 2 months. But then as we got into 2017, you actually saw yields start to fade and trade lower, even as we were negotiating things like the Tax Cuts and Jobs Act, which did contribute to the overall deficit. So we could be in a sell the rumor, buy the news kind of scenario with bonds today, where you're pricing in the potential of these higher deficits. But the reality is that a lot of the policies that could contribute to higher deficits, like the extension of those tax cuts, don't get negotiated until we get closer to the end of 25 and into 26. So we could have this jump higher in the near term and then a fade post the election, potentially.
Cameron, this is fascinating, regardless of who wins. Is that correct?
I think that is correct, because what we see is that both candidates are talking about potential additions to deficits, and they're really not considering things like all-out austerity. Now, there are offsets to the things of the extension of tax cuts, for example. So if we think about from Trump's camp, he's talking about offsetting the tax cuts through tariffs, whereas through Harris, she's talking about offsetting the extension of personal tax cuts through higher corporate taxes. But even with all of that, you see this contributing to overall deficits, which just means that we have to get used to higher Treasury issuance. We have to get used to these higher deficits because neither party is talking about all-out austerity.
The interesting thing about this, Cameron, is a lot of people expect that this type of scenario with more fiscal spending, with bigger deficits, yes, come with higher yields, but also with more robust gains for a lot of equities, because a lot of companies will maybe do better if there's less regulation, fewer taxes, et cetera. I see you shrugging. And that's exactly what I wanted to ask you. How much is this the opposite? How much does this really lead to the draw of higher yields, sucking investors into the bond space at the expense of equities and the returns there?
I think a lot of that hinges on what the Fed does in this environment. If you go back to Econ 101 classes, you would typically argue that if you have highly stimulative fiscal policy, you should not have highly stimulative monetary policy because you get inflation. And what's interesting is that given the fact that you have high fiscal stimulus at the same time as an underlying economy that remains resilient, you're now having the Fed talk about potentially hundreds of basis points of cuts to get back to this phantom neutral rate, which would effectively be like throwing lighter fluid on a fire already of this underlying strength within the economy. So it raises the question of, if we actually get these kind of deficit blowouts, do you get as many cuts as the Fed or the bond market has currently priced in?
Is that potentially more of what the market is reading into, less of the politics?
Quite potentially so. I think that Lisa's point earlier about inflation break-evens is interesting, because one of the things that you've seen is this all-out confidence by the bond market that the Fed will be, in fact, successful of getting inflation back to 2%. And though we don't see signs today that inflation is reaccelerating, look at things like wages, look at oil prices, observable rents, none of those point to an imminent reacceleration in inflation. But we don't think we can rule out higher inflation, or at least stickier inflation, in 2025, given the backdrop of stimulative monetary, stimulative fiscal into a stronger, resilient economy.
Cameron, you brought up a really good point when it comes to TCJA, the extension of these tax cuts, and that needs to be hammered out throughout the course of the entire year and probably won't get done until the very, very end of 2025. But what about tariffs and tariffs' implications for inflation and the bond market?
Yeah, that is something that could be done immediately, and it could certainly weigh on growth. We usually think of tariffs as a regressive tax, that it weighs on consumption. It's a big question of if tariffs across the board, not the kinds of very focused tariffs that we saw during Trump's last term, but if we got these broad tariffs across the board, could it contribute to inflation? Because you're talking about putting tariffs on things that we simply can't produce in the US, whether it's things like bananas or fish, where we tend to import most of what we consume. So that would be inflationary in the sense of it's a one-time reset in prices. And the question, does that catalyze a greater reflationary cycle? Something similar to what we had, of course, coming out of the pandemic, where it effectively acts as a supply shock. And that's where we have the biggest question, is that if you get tariffs and immigration restrictions, could you see a supply shock that is somewhat similar to the pandemic and thus get your second wave of inflation?
So, Cameron, we've got to put some money to work with all of that in mind. Equity still close to all-time highs. Credit spreads near multi-decade tights. Bond yields at the highest since July. What do you do right now?
I think a certain degree of patience is warranted, mostly within credit markets, which are very much priced for perfection, and broad equity markets, which we think are priced for perfection as well. There are still opportunities under the surface where we see names that are trading at more reasonable valuations. We think that valuation discipline probably is the most important thing to have at this time, given the starting point of such extended and elevated valuations. So it's really coming back to the fundamentals of finding companies that we like with strong balance sheets, strong free cash flow, but aren't being given those big premium multiples because they don't have as exciting of narratives. So we think that you have to remain ultimately valuation disciplined. Don't get over your skis, because this market is not contemplating any kind of growth slowdown or any kind of inflation reacceleration, which we think could be two different kind of polar risks as we go into 2025.
Is this a polite way of saying that you think that probably Goldman Sachs is right, that the annualized returns on the S&P 500 index level probably are going to be pretty tepid over the next decade?
It's certainly possible. We do know that lost decades do happen within equity markets, but the biggest and most important message there is that that doesn't mean to be uninvested. What we typically see in periods of low returns is actually big rotations in leadership that provide opportunities for investors. So you go back to the 70s, it was a lost decade, but the leadership shifted away from big growth Nifty 50 stocks to value stocks. A very similar thing happened in the 2000s. So there's opportunities of the volatility that can happen in a low return environment as well. There's a lot of ways to get to 3%. You could chop sideways for 10 years. You could have a big rally and then a crash, or you could have a crash and then a recovery. So it's incredibly path dependent. So there's a certain marrying of the tactical, which provides opportunities, with the strategic. Even if you knew with certainty it was going to be 3%, you have to know what that tactical path is going to be.
Cameron, appreciate your take. As always, thank you. Cameron Dawson there of NewEdge Wealth on this equity market. Your stock market right now negative. Close to session lows. We're down by 0.5%. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Some earnings to get through this morning. GM higher pre-market, 1.6%. The automaker reported third quarter earnings that beat Wall Street estimates. It raised its full year guidance. There was strong U.S. demand for SUVs and trucks. All of that offset losses from its EV business and continued red ink in China. Elsewhere, GE shares also now lower pre-market, 5.6%. The company did report a jump in third quarter profit. It also raised its full year guidance. The aircraft supplier is capitalizing on a strong order book and maintenance service businesses. It also had an improved outlook. It does point to GE's adaptability to a volatile environment plagued by supply chain issues. A day after the New York Liberty won their first WNBA title, a new contest is emerging in the league. According to the union, players opted out of their collective bargaining agreement 2 years before it expired, pushing for a more lucrative deal. If the two sides indeed do reach a deal, it will go into effect in 2026. If they can't reach one, though, a lockout might occur that season. The union said that it has a handful of priorities for negotiations. That includes getting a cut of revenue, higher salaries, improved benefits for retirees, and pregnancy. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the partisan divide.
We've been through a lot together, haven't we? Huh? We suffered for 4 years.
We need to be able to have these good, intense debates about issues that are grounded in fact.
That conversation up next, live from New York. Good morning. Two weeks out from Election Day, and this market gets more and more interesting. pulling back from all-time highs. We're down another 0.5% on the S&P, and the interest at the moment firmly on the bond market. Yields up another single basis point, Lisa, 420.56.
A lot of people discussing, and we've been discussing it all morning, how much has to do with the expectation for the results of the election, how much has to do with better than expected data. You see both when you underlie the actual yield rise. You see it both in inflation expectations. You also see it in the extra premium, the real yield over inflation expectations.
2-year up another single basis point, right now 4.04%. Under surveillance this morning, the partisan divide.
We've been through a lot together, haven't we? Huh? We suffered for 4 years. For 4 years, we suffered. Our country suffered.
We need a healthy two-party system. We need to be able to have these good, intense debates about issues that are grounded in fact.
So here's the latest this morning. Kamala Harris highlighting the importance of a healthy two-party system. But Bloomberg Opinion's Mariana Klass pointing out 82% of Americans live in a one-party controlled state. Mary warning at steamrolling US voters, writing the shifting dynamic is suppressing competition in elections, discouraging voter engagement, and in too many places, enabling the party in power to ignore perspectives outside of their base. In short, political choice is vanishing. Mary joins us now for more. Mary, welcome to the programme. Let's start with how you define one-party controlled state, and ultimately, if it needs fixing, how do we fix it?
Well, one-party control is when both houses of a state's legislature and the governor are under the control of one party. And we are in this situation, as you mentioned, 82% of the country is in a state controlled by a single party. And this is the highest we've seen in 70 years. In modern history, we really haven't seen this kind of lopsided control at the state level. And it really does kind of result in fewer people having their voice heard. And, you know, it goes down to the point where there's a lot of legislation that's passed that, according to the data, and we really looked deeply into what was happening, there are so many decisions that are made that only one party is voting on. There were 2,000 pieces of legislation on big items passed between 2021 and 2024 without a single vote from the opposing party in states across the nation. So this is really a lopsided situation.
Mary, to understand where we are, can you walk us through how we got there?
Sure. Well, a lot of it has to do with the fact that we've really watched gerrymandering happening, where one party that assumes control wants to retain it and, you know, jiggers the map in such a way that it benefits its own party and reelects people. We've also watched as there's just been kind of a growing apathy among voters. When two parties don't compete, it obviously suppresses voter engagement, because there's this, you know, fewer people are elected or fewer people are competing for the same jobs. And the thing that is really kind of stunning is the number of people that at the state legislature level that walk into office with either only a primary, or even more alarming is with no primary and just walk in without competition. This year, 38% of all state party legislative seats will be filled without a challenge from the opposing party. So really, that's thousands of seats, like 2,100, 2,100 and more. And that signals that we really have an absence of competition, which means that these super majorities have control of a legislature and can push things through.
Mary, I'm thinking of the South, though, and some big red states like Florida and Texas. 9 of the 15 fastest growing cities are in the South, according to data. And when you look at what's happening there, is you're actually even seeing some competition in, say, a statewide Senate race when it comes to Texas. Aren't the demographics shifting that potentially could mean more representation for, say, Democrats in the South, or maybe even Republicans in the North, because you do see people migrating in different directions?
Well, it's one thing to have a electorate that is got blue and red, and it's another thing to have the state legislature. And that's what we are seeing. in places like Georgia that has two Democratic state U.S. senators and a Republican governor. The Republican legislature there has been under one-party control for decades, and that is reflected in the kind of policies that they are passing at the state level. Texas is another example. Yes, there may be competition in these in congressional related seats, and actually in some places within the within the governorship. But when it comes to the state legislature, where all these policies that can affect people's lives, that's where the competition has disappeared, and that has an effect on people in many ways. I mean, states will be certifying the presidential election this year. States determine how much Medicaid gets to people, healthcare decisions, broad decisions as it relates to education, obviously. And we will be talking a lot more about that if Trump is elected, because he wants to continue to push decisions back to the states, like abortion. As we've watched. So, yes, there is some competition in some of these big states, especially those that are growing in their blue metropolitan areas, but we don't see that reflected often, especially in the South, in their state legislatures.
Mary, just to sort of pose a hypothetical to you to give a better sense maybe of the picture, are you saying that gerrymandering has made it so that even if there is a significant majority in the population of the opposing party, you still would see a single party rule that has been the same for a very long time in a lot of states?
That's exactly right. Yes. And once the party is in control, they can draw the maps to make sure that their party stays in control. And, the answer to this is to reward competition. When you elect someone, when you have a choice between who's going to be elected, look at the people that are more willing to work with the other side. When they ice out debate, when, legislative leaders shut off the mics and don't want to, let others even discuss an issue. And even more importantly, when they don't hear the bills of the opposing party, that is the kind of thing that continues to reinforce this sort of vicious cycle.
How much are we seeing, Mary, people vote with their feet? I mean, if they don't like a state's policies, can't they move to another state?
And we are seeing that there seems to be some sorting in that regard as well. But think about that. Do we really want to be a state where, if you happen to be in the minority party, you have zero voice? Geography should not determine destiny when it comes to a democracy. Your voice you should have a right to be heard. And it doesn't mean that your party's always going to, has to control everything, but there needs to be sort of that bipartisan willingness. And what our data shows is that it's increasingly less likely, especially in red states, that the policies that are passed have public support. So, we looked at, there's a lot of data out there from some really smart political scientists who've looked at the kind of policies that are passed in red trifecta states or blue trifecta states. And we analyzed that and found that 53% of the major policies passed in red states received the support of the majority of voters, and blue trifecta states had the support of 77% of voters.
Mary, we've got to leave it there. It's good to get your thoughts on this subject. Mary Ellen Klass of Bloomberg Opinion. Certainly very little evidence it's hurting turnout over the last few cycles, that's for sure. Torsten Slok of Apollo and why he still sees a no landing in America up next. In about 60 minutes' time, we'll sit down with Gilles Moëc of AXA. And Gilles going to compare the United States to Europe, and we'll talk about the different perspectives on the US election 2 weeks away. Take a listen to Seth Carpenter of Morgan Stanley. In the US, a majority of clients doubt former President Trump's resolve to add the substantial tariffs he's promised. But over in Europe, clients in London were convinced that he should be taken fully at his word. Two very different perspectives based on where you live right now on tariffs in America.
How much of this is because of what people expect the ramifications to be? A lot of people saying the ramifications will be a lot bigger for European companies and countries in terms of higher costs and lower earnings if the U.S. does put up the walls, even to some European allies.
Yeah, I'd agree. I'd suggest the same thing, that that's dictated, determined by varying degrees of fear about what it might mean for them personally.
Yeah.
We'll catch up with Gilles Moëc and get his opinion in about 60 minutes' time. Equity futures on the S&P 500 look a little something like this, pulling back on the S&P, pulling back on the Nasdaq, lower on a Russell 2000. We're down by 0.6% on a Russell. On the S&P 500, down by 0.4. The fireworks, as we've said a few times already this morning, is in the bond market. 2-year, 10-year, 30-year, shaping up as follows. Yields just a little bit higher, much higher in yesterday's session by double-digit basis points from 410 to 420, 419.77 on a 2-year, 4.04%.
It's sort of shocking to see how the yields have basically bounced back to where they were before we got that July weak jobs report. Essentially, we have retraced any of the expected sort of deceleration of the economy, the need for the Fed to cut rates aggressively. We've gone full circle, and yet the Fed is still planning to cut rates, and they have already cut rates by 50 basis points. What's interesting here is this is a market grappling not only with election risk, not only with the Citi U.S. Surprise Index for economic data coming in at the highest level since April, but also the prospect that going forward, we are going to end up with a significantly higher neutral rate than maybe they thought a couple months ago.
Go back to when the Fed cut interest rates 50 basis points. Where was the 2-year? Where was the 10-year? The 2-year was at about 360. The 10-year was at about 360 something. Look at where we are now. That's a big repricing of the yield curve after some Fed easing and the promise, by the way, of more to come. This market's not been driven by Fed speak. It's been driven by the data and the expected data 1 year out based on what may or may not happen in an election 2 weeks away.
Especially when you add to this the earnings that show the companies are in really good positions and the consumers can keep spending. It is, sort of soft landing nirvana that we've been talking about now. Maybe we have to ask to take a page out of this one man's book. Is it a no landing nirvana? And maybe we can catch up with that man sometime soon.
That man is around the table and a few minutes away. I want to finish on foreign exchange. The dollar off the back of those high yields, just a little bit stronger. Euro dollar coming really close in the last 24 hours to breaking down to 107. 108.27 is where we trade right now. Under surveillance this morning, shares of GM rising in the pre-market. The automaker delivering a beat and raising its full-year guidance. The company adding, quote, "We remain on track to reach our 2024 EV production and profitability targets." That stock, Lisa, up by 1.1%.
What struck us both, all of us, was this real divergence between U.S. auto manufacturers and what we've heard from the European ones. Yes, it is a stark difference. What I want to hear from the earnings call, looking forward, what kind of growth is there? How much is this a U.S. auto manufacturing sector that's ready to rip versus just cutting costs, being disciplined, and executing where they can? And that's going to make the difference between a potential stock that could really gain and an entire industrial sector, or maybe just, okay, you guys did a good job. What do you have for next quarter?
Especially as the battery-powered models continue to lose money for GM. You have Mary Barra saying the company is working to, quote, make our EVs profitable as quickly as possible. How much harder is that going to be if you start to dial back some of the subsidies that consumers can get when it comes to purchasing electric vehicles if the politics change next year?
We've said this a million times. The destination for government officials is still the same. They want a full transition, but they've had a massive reality check about how long it's going to take to get there. And the automakers, particularly in Europe, are pushing back and saying, your goals now are so unrealistic that we can't make them, and you've got to admit yourselves that we're not going to make them. And plus, by the way, you still need to provide more state aid to incentivize the purchase of these vehicles. And if you don't, we're going to have to shut a lot of factories across the continent.
Which is the reason why at the IMF meetings, at the World Bank meetings, they're going to come out and say deficit, deficit, deficit. Look at how terrible it is. Look how much public debt there is. At the same time, auto manufacturers are saying you need to spend more to support us or else we're going to have to close plants, and that's going to mean losses of jobs. So it's sort of a double-edged sword here between a rock and a hard place for the European auto manufacturers.
GM right now in the pre-market up by about 1%. Some good news from Maersk, raising its full-year guidance again for the fourth time in less than 6 months, perhaps for the wrong reasons. The shipping giant citing stronger demand and higher freight rates caused by attacks in the Red Sea. Maersk signalling it expects the Red Sea to remain unsafe well into next year.
We are a year into this conflict, and still you do not see the regular flow of trade going through the Red Sea. Now they're going around Africa, and that is why it is so expensive. And Maersk, they don't have a timeline. Why? The U.S. government doesn't have a timeline on when potentially they're not going to have vessels being hit by Houthis within the Red Sea. I think that is a very underappreciated story for this global economy and the impact of what that story alone means for inflation.
This is not really something you can provide a timeline for, is it?
No, absolutely
Ultimately,
not.
this comes down to policy. You're going to provide an appropriate, adequate deterrence in the region or not?
Well, the deterrence is there right now, but what does it mean? It means that basically U.S. men and women, service members, are protecting what kind of vessels that are willing to go through the Red Sea? Oh, Russian and Chinese. Not Western vessels. Why? They're too concerned that they're going to get hit by Houthis. They're the ones that are paying up these costs and going around Africa.
That's the latest on Maersk and that situation in the Middle East, and particularly through the Red Sea. And I wish we'd spent more time on that in the campaign, but such is life. We didn't. The US continuing to ramp up pressure on Russia's war machine. A senior State Department official telling Bloomberg Washington will tighten the screws on Russia's liquefied natural gas. The US sanctioned a new Arctic LNG export facility just last year, but stopped short of sanctioning other plants. Elsewhere, Treasury yields continue their climb on election expectations and easing rate cut bets. Torsten Slok of Apollo saying 10 tailwinds are increasing the likelihood that the Fed will have to reverse course at its November meeting. In short, the no landing continues. Torsten's with us around the table. Torsten, good morning.
Morning.
When you say reverse course, do you mean pause or start going the other way?
I mean pause.
You mean pause?
Yeah.
OK, share the 10 tailwinds with us.
Well, so the key tailwinds, of course...
Not a memory test, pick 5.
Okay.
I was about to
a lot
say.
of things that are supported for, of course. First of all, most importantly, when the Fed turns dovish, financial conditions begin to ease. This has been a very strong tailwind just in the last few weeks since the September meeting. Second of all, underlying the growth outlook, we also have the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. Those are also very strong tailwinds that continue to provide support to construction of manufacturing facilities. We also have on top of that a lot of spending on data centers, on AI. I have not met anyone who is saying, oh, I'm not going to build a data center because the Fed just raised 25 basis points. On the contrary, this is a structural force. It doesn't matter what interest rates are doing. At the same time, we also have at the highest level, stock markets are rallying, credit markets are very tight, and at the same time, consumers are still very strong. So overall, the tailwinds in the form of what will the outlook look like for the next several quarters just continues to not be surprising why we're getting still 254,000 jobs, why GDP growth in the second quarter was 3%, and Atlanta Fed GDP now for the third quarter is 3.4. I mean, you really do begin to ask the question, where is the slowdown? And as we have been debating before, is monetary policy really restrictive? If it is so restrictive, why is the economy still doing so well?
They don't just believe it's restrictive, they believe it's sufficiently restrictive to get inflation back down to 2% over a certain period of time. Do you have your doubts then?
So, well, it becomes a bit of a semantics of what exactly does it mean, because it was for a long time the argument that when the Fed funds rate is where it is at the moment at 5%, and if we are supposed to go to our star, which is 3%, that must imply, if you have that model in your mind, that we have very restrictive policy. But the incoming data across the board, if you look at the daily data on your Bloomberg screen for how many people go to restaurants is still very strong. How many people fly in airplanes, daily data also very strong. Debit card spending on my Bloomberg terminal, also daily data very strong. Weekly data for retail sales strong. The number of people who are at the moment spending across basically most categories of consumption, as we saw in the retail sales report last week, also very strong. So in that sense, it's not even the case that there was a slowdown last week. It's still the case that things are still chugging along very nicely.
That said, you are seeing in surveys and talking to different executives that they're not really planning on hiring mass groups of people, that they're actually allowing attrition to shrink their workforces. You are seeing signs that there is a sort of evening out in the labor front, and that seems to be the big concern for the Federal Reserve that sees that as a slower moving ship. Why do you think that isn't enough to really create a landing?
Well, if you look at the Challenger Gray and Christmas survey of the announced job cuts, that's still very low. This is a monthly series where they go out and ask companies, are you planning to do mass layoffs? And the answer to that at the moment is there's no increase in mass layoffs. In the JOLT survey, the layoff rate, meaning the percentage of people who lose their jobs, is at 1%. So total employment in the US is about 160 million people have a job. So the layoff rate means that 1% get involuntarily fired every month. So that's 1.6 million people. But that's been very flat. for the last 2 years. There's no increase in the layoff rate. So in that sense, yes, there's a lot of worries, and there's certainly a lot of things on the horizon, including election, geopolitical risk, other things you can begin to think about. But the bottom line still is that the incoming data, it just continues to show that the economy is doing just fine. Jobless claims, we had some hurricane issues, but look at the next non-farm payrolls report. If we do get that at 150 or 200,000, we could easily get a scenario where the Fed will basically have to reverse course and begin to stay on hold.
Are you saying that you're completely discounting the next jobs report that we get?
So I will say that I think the pain trade for the market is that if it's a lot better, because everyone is expecting it to be bad now. So that's why if everyone expects it to be bad, then well, that could either be the economy slowing down or it could be the hurricanes. But imagine if that comes in at 150 or 200, then I think the market will say, whoa, maybe things are not that bad. So I think taking the totality of the data, the mosaic of what's going on in the incoming data, it still tells me that we are in the no landing scenario. It's just really difficult to argue that monetary policy is restrictive.
How many more months of this do you need for the Federal Reserve to come round to your view of the world? Is November 7th too early?
So I do think that the next employment report obviously is very important, but I think that everyone is expecting it now to be bad. So that's why I think it will not take much more than a little bit better than expected employment report.
What is bad, by the way? Because you said 150 might be sort of the pain trade.
Well, as you know from Tara Watson and Andy Whittleberg at the Hamilton Institute at Brookings, they have been quantifying what is the level of employment growth now we've had so much immigration. And their estimates have said, well, we should be more like 200,000. Now the question is, well, if we do get 150, well, that will certainly be below that. But if you correct for hurricanes and all the other things that are holding things down, well, then I would say a good report would certainly be even something at 150. Bad would be below 100,000. But at the moment, again, the totality of the data that comes in, it completely justifies both why Fed's pricing is changing and also why long rates are going up.
John asked a question about potential reinflation, which I think is a really important one, because even as people see all of this robustness, they still see prices on a year-over-year basis continuing to come down, and that alone is enough to justify some of the Fed moves. When you take a look at the panoply of potential policy that we could potentially get, when you start talking about manufacturing more in the U.S., when you start talking about tax cuts, how much does that actually feed into inflation? What are your models looking at?
Well, what's most important is what is the fiscal impetus? In other words, how much does it support GDP? And of course, if you look at it from the broader perspective, the Trump tax cuts that are running out by late 2025 become very important in that discussion. But that's still quite some time away, only in 2026. So the story here and now is still in the very near term that we still have tailwinds from the fundamental reasons why the economy continues to do so well. But to your question, Lisa, what really becomes important for inflation is that if this easing that now is being signaled by the Fed begins to mean that we still have more job growth, we still have more wage growth, which are very important drivers of housing demand. That means that the 40% of the CPI basket that is housing, if that begins to reaccelerate, then we could have the risk that inflation begins to move higher again. So that's why we're watching very, very carefully what's going on in the housing market at the moment, because there's already a number of indicators suggesting some more signs of life, which could potentially begin to be that problem that inflation could begin to move higher because of housing inflation moving higher.
Is that just a vicious cycle? Basically, people think the Fed's going to cut more, so they start to potentially look at maybe getting on the property ladder, maybe going out and getting construction done on their homes?
Well, the Fed has since December been signaling that now rates are going down. The pivot in December of last year was certainly after having said for several years rates are going up, to now say rates are going down. And at the same time, the key drivers of housing demand, of course, are three things. Mortgage rates, of course, they are a little bit up now again, but the two other key factors are wage and income growth, and at the same time, job growth. And wage growth and job growth still doing fine. So it's not surprising that we're seeing the housing indicators begin to show more signs of life.
Let's talk about fiscal policy. You see in the bond market today, some people coming on this program saying this is down to a Trump trade. Do you believe that?
Well, if you look at your Bloomberg screen at the term premium, both from the San Francisco Fed by Jens Christensen and also the New York Fed term premium, they have been going up quite a lot. And when did it start to go up? It started going up exactly after the last employment report. So in that sense, I would say that most of the rise in the term premium we're seeing here, meaning most of the rise of why is it that people are now betting higher rates to go up and why is the yield curve steepening, is because of this issue that people are looking at it from that the business cycle is simply a lot stronger than what we thought before. So there's probably a lot of people that are squeezed out of the short view, meaning that the economy is going down and maybe it's now not going down and therefore rates have to go up. But there's probably also a lot of people that are beginning to come to the conclusion that hey, maybe monetary policy is not as restrictive as the Fed has been saying and as the market has been telling itself for quite some time.
Torsten, in your scenario, your look at the world as it is, does that mean that where rates are, even if they go to 4.5% on the 10-year, you could see a sustainable rally in equities, that essentially this is a less bond-sensitive equity market than a lot of people think?
Well, I do still think that corporate earnings are actually still doing quite well. What really is the key issue for investors is that if yield level is higher, that means that private credit will continue to give you higher yields, fixed income will continue to give you higher yields, and for investors and asset allocation, the key message is we are not going back to zero. So therefore, capital structures that were put in place when interest rates were zero will continue to be vulnerable, or put in different words, companies that have earnings continue to be attractive, both on the debt and on the equity side. And the reason why that's important is that also means for equities that this discussion about small cap relative to large cap will continue to dominate the debate in the equity space, because small cap will continue to be vulnerable if rates are higher for longer. Because again, if I have a company with no revenue, no cash flow, no earnings, of course, when my debt servicing costs go up and stay higher for longer, of course, I'm going to get in trouble before other companies that actually have earnings. So that's why it is all about investing in companies that have earnings and looking at it both on the debt and equity side. And that's why those parts of the equity and private equity world where you invest in companies with earnings will generally tend to do a lot better.
Torsten, this was a clinic. It always is. We appreciate it. We've had a healthy debate over the last few months on this topic, and the data's moving your way, that's for sure. Torsten Slok there of Apollo with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Strategists at Citi are out with a new warning that exposure to the S&P 500 has reached levels that were followed by a 10% slump in the past. The team isn't suggesting that investors move to reduce their exposure, but they do say positioning risks are rising. The S&P 500 is up over 20% so far this year. Norway's $1.8 trillion sovereign wealth fund returned 4.4% or $76 billion in the third quarter. Those numbers reflect broad equity gains on declining interest rates. Norway's central bank, which is the world's biggest single owner of listed equities, added 4.5% on stocks in the period and 4.2% on fixed income investments. All of that according to a statement this morning. Russia and President Vladimir Putin are playing host to the country's biggest gathering of world leaders since the invasion of Ukraine. Leaders of 32 countries and a host of organizations will join the BRICS summit starting today. Members are split on the direction of the group and interests as a counterweight to Western countries. Nations are debating less reliance on the U.S. dollar and challenges to cross-border payments to circumvent the global financial system. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next, room to run for the banks.
The amount of liquidity in the markets is phenomenal. The banks have plenty of room to lend. They see the economy looking better.
That conversation up next, live from New York. Good morning. The equity market rally stalling just a little bit this week. Down yesterday, just a little bit. Down this morning, just a little bit. We're down by 0.5% on the S&P 500. Under surveillance this morning, room to run for the banks.
The Fed is truly going to continue to ease and cut rates between now and the end of next year. We're in the soft landing. The amount of liquidity in the markets is phenomenal. The banks have plenty of room to lend. They see the economy looking better. We could see better lending, particularly in commercial and industrial lending, as companies start to build out inventories, take on capital expenditures, and the commercial banks will be beneficiaries of this.
So here's the latest. The big banks rallying on the back of earnings this month. Chris Marinac of Janney Montgomery Scott writing, we see many other banks capable of catching up to the leaders as their third quarter earnings have been solid. And more importantly, their outlook for fourth quarter and early 2025 is positive. Chris joins us now for more. Chris, it's been quite a run for the major banks. The big banks on the S&P 500 up by more than 25% so far in 2024. In your opinion, the recent move, and there's been some debate on the programme about this in the last few days, is it about the earnings or the politics or a little bit of both?
I think it's more about earnings, John. I think earnings are signaling that credit is much better than anticipated. If you go all the way back to spring of this year, there was a lot of credit fear in the banking system. about another failure round like we had in 23. That is completely in the rearview mirror now. And the industry is in a much better place. We've had credit losses, credit problems being very much under control. The signals for fourth quarter and early 25 are that credit's going to stay very low on losses. And the Fed's recent cut gives a lot of flexibility for any problems that exist in commercial real estate, in C&I and elsewhere. So I think we're in a really good spot. And now you have the acceleration of net interest income and net interest margins because of the Fed cut. It'll be interesting to see if the Fed does pause to today's conversation. But I think overall we're in a very good spot.
Chris, do you think that smaller banks, regional banks, are ready to start accelerating their lending arms? Basically, we're wondering about the state of the economy. Have we gotten to a point where yields are low enough for them to really be major lenders once again to a lot of the small businesses in their communities?
I think we definitely are. I think banks were on a diet for the last 18 months on their balance sheet to try to keep liquidity high and give themselves some capital flexibility. Now that is completely behind us, and going forward, I think demand's going to pick up. For a bank to go from 2% to 3% growth is actually very important, particularly when net interest margins are starting to inch up, and they are. So I think the inflection point on revenue is very much here. So I do think lending is going to improve, and I think the pace next year, particularly with the no landing scenario, could be quite positive.
Do you have a sense of the risk appetite of some of these banks? And I like that you talked about the no landing. We were just talking about Torsten Slok, and this fits perfectly into that. I mean, if you have banks that are reaccelerating their lending mechanisms into an economy that looks pretty good, well, don't you really start to look at a reacceleration and perhaps even inflation levels, benchmark rates staying at this level for a longer period of time?
Sure. I think it's a real scenario. It's one of the reasons I've been very loath to kind of cut my forecast for the Fed. I think the Fed funds is going to be slow to 450 and 425 as next year plays out. So that's exactly right. And I think in general, a little bit of steepness in the yield curve is very healthy. And if anything, the cost of funds has rolled over and peaked. So that's allowing bank margins to get better. Right now, you want more volume. So I think the risk appetite is incrementally better. It's not going to be dramatically higher, Lisa, but I think it will be better than it had been the past 3 to 6 months.
Chris, let's make sure we finish on top picks. What are they?
I like Fifth Third, FITB, Synovus, SNV, Wintrust, WTFC, and we also like WAL, Western Alliance, which we think was penalized on Friday.
Appreciate it. Interesting. Chris, thank you, sir. Chris Marinac there of Janney Montgomery Scott on the banks. So let's compare and contrast some notes, shall we? Came into this morning asking, is it the data or the politics moving the bond market? Torsten Slok of Apollo suggesting it's the data. Had a conversation there about the banks. Stocks are doing quite nicely. Is it the earnings or the politics? It's the earnings, according to Chris Marinac.
He's talking about the likes of Western Alliance, which was one of the most beaten up stocks during the whole regional banking crisis. This looks like a fundamental story that has the overlay of a whole host of people who are looking to make some kind of definitive statement about the election that we have to deal with for another couple of weeks or maybe more, and have to make something sound smart with. I'm sorry, not to be skeptical, but I think that there's a lot of that.
No snark there whatsoever.
If you think about it, all of these analysts have to talk to clients about the election, and they have to come up with something smart to say. Okay, this could be it. But I mean, honestly, do we know anything about how it's going to really shake out?
Number one question I have is, how quickly do you think we'll get a result? How long do you think it will take? How many days?
Oh, God. Do you really want...
End of the week?
I hope, it'll come right away.
If we're lucky?
We'll know right away. It'll come out. No, that's going to take a long time.
2020 was days. This could maybe be weeks.
Maybe longer. But who knows? Coming up for the next hour, Brent Schutte of Northwestern Mutual, RBC CEO, Dave McKay, Gilles Moëc of AXA, and Jitania Kandhari of Morgan Stanley Investment Management. Live from New York, this is Bloomberg.
If you look at the environment, at least in the U.S., it is pretty encouraging. Stocks reflect that.
If you're printing earnings growth like we're printing, then I think it's going to be hard to keep people out of U.S. equity markets.
Sentiment is probably not overly enthusiastic, but certainly bordering there.
At these valuations and at these levels, it makes it hard to have a positive surprise, and it makes it easier to have a negative surprise.
At the same time, look at equities. That's where I look for opportunities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
What a move to start the week in the global bond market. A double-digit move on a 10-year yield in America. In Germany, a similar amount. In Australia, A move of 16 basis points, a global, worldwide sell-off in the global bond market. This morning, yields stabilized close to 420 on a 10-year, 419.57 on a 2-year. 4.05% yields up by 2 basis points.
A big question about why. We've parsed through whether it has to do with the U.S. election, whether this has to do with economic data. There is a larger question here, which is that the supply of debt coming online is significant. And we're talking about an economy that doesn't seem to be falling off a cliff, thanks to the U.S., thanks to a couple other engines as well, although mainly the U.S. And so it raises a question about whether we are permanently in a higher rate environment for a longer period of time. And the big debate is how much influence that it has on some of the other asset classes.
Torsten Slok was just on with us, and he said, look at the term premium. That's been rising since basically the middle of September, and he sees with the continuation of that, basically what we're seeing play out in financial markets right now. Yet, Jonathan, you brought up Neil Dutta earlier. His line, my working assumption is that financial markets have a lot of Trump priced in. Also, Sharon Bell from Goldman Sachs. Yes, the Trump trade being priced in. The election is just 14 days out. So if you have any sort of idea on how you think this is going to go, you are going to start to add to these financial markets.
I'm pleased you brought up Neil Dutta of Reiman, because Neil has a bit of a different view on the outlook for the economy compared to a Torsten Slok of Apollo. Neil points to the anxiety in the labour market, which is something, Lisa, you've pointed to as well, as just a sign that maybe the setup for Q4 through the end of Q4 isn't as good as some people think it is.
If you listen to what companies are saying, that's the reason why we're going to be listening to the Beige Book. I will be reading it. You will be reading it too. We'll be picking out nuggets. But they are not saying that they're looking to hire. In fact, they are looking for attrition, people to leave. You're hearing about cost cutting, even with the likes of GM outperforming, still engaging with cost cuts. This isn't necessarily gangbusters, let's go, go days are here. So it raises this question, could you start to see layoffs on the margins? Should there be any type of shock or any type of concern coming forward?
Yields this morning on a 10-year, just short of 420. In the equity market, pulling back and close to session lows. On the S&P 500, we're down by 0.4%. On the Russell, more underperformance. We're down by 0.6. Coming up this hour, we'll catch up with Brent Schutte of Northwestern as stocks confront higher bond yields. Dave McKay of RBC on bolstering US-Canada trade relations. And we'll catch up with Gilles Moëc of AXA on the US versus the rest of the world. We begin this hour with bond yields nearing the highest level since July as investors scale back rate cut bets and consider a Donald Trump election win. Brent Schutte of Northwestern Mutual saying this: while it may be months before we know if the Fed is able to cut rates fast enough to resuscitate weak areas of the economy, the bifurcated nature of the economy brings with it risk. Put simply, there is less room for error when only a fraction of the economy is healthy. Brent joins us now for more. Brent, welcome back to the programme. Last time we had this conversation, we were debating whether this Fed is too late. There are people around this table now saying that maybe this Fed was too early. What do you say back to them?
I think that highlights the difficult path going forward for the Fed. Look, investors are way too optimistic that the Fed is going to cut rates in a nice, neat, and tidy way. There is the possibility they cut rates too quickly, the possibility they cut rates too late. They don't know, we don't know, and I think that's where the risks are, is that there is the chance that the Fed has cut too early already and that inflation pressures are coming back. The narrative was the Fed would cut rates, everything would be well, and it would alleviate the interest pain on certain parts of the economy. Well, the Fed cut rates in the 10-year Treasury 60 basis points higher, which has pushed mortgage rates higher, which has made housing more unaffordable for most every American in the country.
So, Brent, bad if you want to buy a house. Where does it leave the equity market? You were cautious last time around. You were cautious on large caps, I believe. Slightly more bullish on smalls. Has that changed?
No, that's the irony. I mean, you've had a bifurcated economy in a bifurcated market. At some point, we have to get back to equilibrium. How do we do that longer term, I think, is the question. And do we need a recession to do it, which historically has been the way that you've got an economy back into equilibrium? I think the irony is there's opportunities in small and mid caps because, yes, they are interest rate sensitive. Who doesn't know that? I could say stay in quality for a while and it could continue to work. But think about the other side. What happened in July when we thought the other side was coming? There was a ferocious rally in small and mid, which are historically cheap. And that's where I think any investor should think about right now, given that uncertainty. Look to valuations, which tend to matter more over the intermediate time period as your guiding light and guiding post. And that's where we're positioned right now.
Brent, I'm trying to put these two things together, and I'm a little bit confused because if there is this risk of a no landing and inflation being stickier than expected, and frankly, longer term yields rising if the Fed cuts more, why go into the more interest rate sensitive stocks that actually hinge and do better when you get more Fed rate cuts, which don't seem like they'd be in the offing given some of the better than expected data and the performance that we've seen in bonds so far?
Look, at the end of the day, the Fed knows how to get inflation down. It knows how to kind of stem inflation overall. We saw what had to happen back in the 80s. To me, it's always about what happens next in market and what's not priced. If you look at 1999-2000, which I think is a perfect example for where we're at when the market was concentrated and we were in economic cycle over time, you actually saw small and mid do better into that recession and thereafter because they had already priced in the fact that it was likely we're going to have a recession. And that's where I think we're at right now. And that's where I think thinking beyond the next 3, 6, and 9 months and thinking out to the next 2, 3, 5 years, that's where I want to be positioned because no one's thinking that way any longer.
One thing that you point out is, and you keep saying, is valuations. And that's one of the main drivers for you right now, given how high valuations are, particularly in large caps. That's the area you like least. Why is the argument not valid with, say, investment grade bonds where spreads are pretty tight and valuations are pretty full also?
It is. I mean, I agree longer term interest rates are likely to be higher, but I think the path is lower at some point, just because I do think you're going to have a recession to kind of clear the deck of all the abnormalities that are out in the economy, where you have the haves that are winning quite a bit and the have-nots that are not. This is where I think we want to be more towards treasury debt, even though I do see longer term risk there. I think there will be a flight to quality, much like there was back in July, believe it or not. And that's where I think we want to be positioned more so. So not so much out on high yield. I think investment grade high quality is still a place to be as you think about the reality that the Fed will only be able to cut rates aggressively if they do see a recession on the horizon.
Brent, we're 14 days out from the U.S. election, so I have to ask about how you're your advice for positioning ahead of that. You like the small caps. Do you think that is a Trump trade that's on right now because of policy or because of economics?
I think it's a bit of each. Look, I don't want to overweight the election too much. I don't think anyone knows what the outcome's likely to be. And therefore, if I don't know what the outcome's going to be, I don't try to position too much for it. It certainly is in the background. I think the more important thing is the economic cycle, which I keep coming back to. Look, we are later in an economic cycle. Yes, the unemployment rate has risen, but it's still low. Where are we going to find the people to fill the supply that is needed if demand reaccelerates? And to me, that's where I think that's the most important thing. And no matter who wins, I think they are likely to preside over a recession in the next 4 years. And I think they're likely to preside over a market, especially large cap stocks that are historically expensive, that does less. That's where I think investors should be optimistic on the other side, where things are cheaper and will do better, I think, when we get to the other side of whatever lies ahead.
Get to the other side. Yeah, we're all looking forward to getting to the other side. When it comes to, though, this idea of potentially your recession call, could potentially the policy of whatever administration we get next further push the U.S. in that direction? Or do you think that is going to happen regardless?
I think it's likely to happen regardless. Look, you have a really unbalanced economy that has been demarcated by interest rates and ownership of financial assets. It's not balanced. The economy is being pushed higher by higher income and middle income consumers who have had a wealth effect at their tails. If you have debt and you don't own a house, you probably don't feel as confident about what's going to happen going forward. And so to me, I do think there are still risks that are out there. And that's all we're asking is that investors pay attention to those risks and importantly, stay diversified, which does tend to pay off at the end of economic cycles, which I think is still out there on the horizon.
Brent, what it sounds like to me is that in some ways you agree with this call that we heard from Goldman Sachs and that Cameron Dawson over at NewEdge seem to agree with, that equity returns on the large caps will probably be pretty muted over the next decade or so. And so you're basically trying to shift things around on a valuation basis with that expectation that there isn't going to be some sort of massive acceleration. Is that correct?
100%. I mean, to me, valuation does tend to matter. It does not matter in the short term. It's an imperfect timing tool. But I think about the regime change that's likely to occur. Look, every economic cycle back to the 80s has had new market leadership. And the prior leaders have become the next cycle's laggards because the economy changes and those asset classes are typically priced for perfection at the end. And that's where I think we're at. And how do you transition from what worked in the past cycle to what we think will work in the future? That's the difficulty of trying to explain the positioning that we have. It's just that at the end of the day, valuation does tend to matter. I don't think valuation is dead. I hear that argument. I've been doing this for 30 years. It typically gets loudest at the end of an economic cycle where people are really tempted to concentrate in yesteryear's winners. Eventually that becomes a losing strategy. And that's why I want investors to stay diversified, stay true to their plan, and think about the reality that asset classes don't die, they just go to sleep for a while. And that's where I think there'll be new winners on the opposite side of whatever comes in the next few months.
This was thoughtful. Brent, we appreciate it. Thank you, sir. Brent Schutte there of Northwestern Mutual. If you are just joining us, welcome to the programme. Equities just off session lows. We're down 1/3% on the S&P. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Secretary of State Antony Blinken is making his 11th trip to the Middle East since last year's October 7th attack. He's scheduled to meet later today with Israeli Prime Minister Benjamin Netanyahu in Jerusalem and Defense Minister Yoav Gallant in Tel Aviv. Blinken has been trying to engineer a ceasefire between Israel and Iran-backed militants for more than a year. The U.S. maintains that Israel's killing of Hamas leader Yahya Sinwar last week may open the door for a breakthrough, even though Hamas leaders and Netanyahu have vowed to fight on. Early voting is underway in states across the country. The votes are pouring in. More than 15 million votes have already been cast nationally. Democrats have been leading in the early totals, but Republicans are not far behind. 46% of ballots have been cast from registered Democrats, 36% from Republicans. Walmart will start delivering prescriptions to U.S. homes in as little as 30 minutes. The retail giant announced the new service that will be available in 49 states by the end of January. Customers will be able to receive their medications in the same orders as groceries and other products. It's a direct challenge to Amazon for a bigger slice of online spending. And that's your brief, John.
Danny, thank you. Up next on the programme, the Morning Calls Plus, Dave McKay of RBC on US-Canada trade relations ahead of the election and what's in store beyond 2024. From New York City, this is Bloomberg. Equities down about 1/3% on the S&P 500. The opening bell around about 1 hour and 15 minutes away. Big focus on the bond market. Yields coming in now by a single basis point after moving out by double-digit basis points in yesterday's session, up by 10 to about 420. We're back down to 418. Let's get you some morning calls. First up, Bernstein naming Walmart a top retail pick with an outperform rating, anticipating e-commerce profitability growth. The story for that stock up by 0.06%. Your second call from TD Cowen, lowering its price target on Walgreens, Boots Alliance to $14, expecting EPS to continue to fall next year. That stock is lower by 0.6%. And finally, Wedbush, reiterating its outperform rating on GM after earnings, citing its robust delivery numbers. Let's turn to the election. Donald Trump doubling down on his trade policy, telling the Wall Street Journal he's committed to upholding the USMCA. The agreement, of course, up for renewal in 2026. RBC CEO Dave McKay weighing in on US-Canada relations, saying it would be inflationary for America to make everything, so Buy America can't be a go-it-alone strategy. Dave joins us now for more. Dave, good morning. It's good to see you.
Morning, Jonathan.
Let's start there. That's a big talking point for both economies, actually. Where do you think the US and Canada can work closely together beyond 24?
Well, you start with the history. I mean, the longest undefended border. You look at the trade, balanced trade, over $400 billion crossing the border each way every year. 34 states in the U.S., Canada's the #1 trading partner. You take out energy, the U.S. exports more goods and services to Canada than Canada exports the other way. Energy exports from Canada kind of balance that trade. So you look at this long-standing relationship. You look at supply chains that are integrated. Very, very important. But the message is, Canada has a challenge and America has an opportunity. And I think that's the key message. For Canada, we have to put a business lens on our economy. And we have to think about how do we become more relevant to the largest economy in the world, fastest growing economy in the world. And if you put a business lens on that, you'll look at what you're good at and what America needs. And Canada needs to do a better job of aligning to what America needs. America needs Canada to produce more energy, not only for America, but for its key trade partners as well globally. America needs Canada to be more involved in overall security. Canada can play a much bigger role in the Arctic, growing area, trade area, resources, minerals, all of that. So when you think about the relevance of our economies, the integration of our supply chains, the natural resources we have, the people resources we have, America can't go it alone because it's challenged in meeting the demand of its economy from a human resource perspective, from a minerals perspective, and therefore Canada can help tame inflation in America.
I'll try and be diplomatic about this.
Yeah.
How big is the spread between everything you said, which just made sense, and the policies coming out of current administrations, both north of the border and south of the border?
Look, America will choose who they want to run the country. At the end of the day, there's some common policy issues I think any government in the United States, and equally any government in Canada as we go through a similar election next year. First and foremost, a fiscal deficit. We will not enjoy long-term prosperity unless we get control of our fiscal deficit. And therefore, as we look at the policies, whatever party they're coming from, we have to manage this fiscal deficit. We've already talked this morning on your show about markets trying to digest the amount of debt coming through. How are we going to price that debt? How are we going to float that debt? We have to get control of these deficits. We don't need that stimulus in the economy right now. The economy is strong. And therefore, lower rates will stimulate further business investment. So I think from that perspective, we're looking for policy that really aims at stabilizing and reducing that deficit, I think is really important. So regardless of who's in power, we need that policy change.
But how desperate is the business community, especially in a place like Canada, for policy that they know is going to stick? You're talking about energy, and my mind immediately goes to Keystone, right?
Yep.
3 administrations, start and go, of this one project with executive orders. Why would any business in Canada want to make decisions about doing business in America?
I think you look at the history, that was one project exactly, and I think everyone's disappointed that we weren't able to conclude that project, even though it was so close to coming online. At the end of the day, we still have the capacity to export to the United States. We're exporting in Canada to new markets. Trans Mountain Pipeline was complete, and therefore we're exporting to Asia increasingly. That helps America as well. At the end of the day, if we can secure energy security for all trading partners, I think that's a big part. So Canada can play a role, even though pipelines aren't being built directly to the United States. We can help trading partners, whether it's in Japan, whether it's in South Korea and others who have an energy need for their growing economies. So there's roles we can play. We're going to go through bumps through the road. This is a long-standing relationship, Anne-Marie, as you know, and therefore we will overcome any obstacles. We have to work together, and I think integrating supply chains, leveraging those resources, you have to think about who you're aligned to from an ideology perspective. I think the democratic process and our belief in democracy, and therefore that long-standing partnership, I think, can flourish to the benefit of both sides.
How are you looking at trade under Harris and Trump? Because regardless of who wins, there's going to be this review of USMCA.
Yeah, I think at the end of the day, when the facts are put on the table in 34 states, many of them red states, many of them blue states, they look at Canada, their number one trade partner. You look at the long-standing relationship. We're going to have disagreements, I think, at the fringe, the way we did last time. I think milk in Wisconsin was an area of disagreement. There's going to be areas of disagreement. At the core, I think we see the benefit to both nations, and therefore, I think we have to keep that front and center. In business, myself as a leader in Canada and a very large U.S. operation, we as business leaders have to keep the strengths and the need for this at the core. And I think we'll argue at the fringe, hopefully, and resolve those. But at the core, we know how important this is.
How much are you yourself planning to continue the expansion in the U.S., or is that pretty much done?
No. Thank you for asking that. We have a fantastic U.S. operation, a top 10 capital markets player, number 6 in wealth distribution. We have a commercial bank and a private bank with City National. And therefore, we very much believe we're serving America, and particularly through our capital markets operation, large corporate and institutional. We're serving high net worth and ultra high net worth individuals for the wealth. We're growing each franchise, whether it's the number of investment bankers we hire, the number of traders we hire, the amount of balance sheet we put into the United States continues to grow. We put a significant amount of our balance sheet into the U.S. We're growing our commercial operations into mid-corporate. And then to your question, Lisa, north-south connectivity. We bank companies on both sides of the border. We understand the needs of the supply chains that are integrated, and therefore we're continuing to build out greater transaction banking and treasury management north-south to help growth in both economies. So we're investing in America, and we call it our second home market.
So to me, this is fascinating because you really understand the cross-border connection for a lot of companies. And I do wonder how much hesitation there is for companies to lean into some of their expansion cross borders, given the uncertainty in policy that we see. Do you see that in practice, or is it the opposite?
No, we do see it in practice. Uncertainty in any outcome for businesses. We see it right now, obviously, in capital markets. There's a lot of dialogue, but we haven't seen the pipelines come to fruition. We see it in cross-border clients where you're thinking about making a 10 or 20 investment. You need to know the rules around those returns, and therefore you're hesitating a little bit. You want to see the policy in action. And therefore, I think as businesses, we have to keep advocating for balanced policies that meet the needs of everyone. I mean, we're really looking at, in many ways, a K-shaped economy. You see it in some of your discussion already today. Businesses and large corporates are feeling a little bit better about things, are starting to get ready to move forward, but to your point, they're looking and they're hesitating a little bit at the margin. Small businesses are really struggling with inflation and supply chain, and therefore you're seeing a different perspective on investing between large corporates and small corporates. You're seeing the same thing on consumers. The top 20% of U.S. consumers are driving the economy. 40% of U.S. dollar consumer spending comes from the top 20% of consumers. Bottom 60% of consumers, income-wise, are struggling to make ends meet and aren't driving the economy.
Can you give us a sense of how much you expect transactions and other types of investments to come back online after the election, regardless of who wins? Can you give a sense of what kind of volume could get generated after there is some degree of certainty, whenever that may be?
Right. So you're seeing the fee revenue in the pools was up 20%. You're seeing capital markets, M&A advisory pipelines build. We're seeing that in our own pipeline. We're feeling good about that. You're seeing more debt capital markets activity as lower rates trigger that. So it's a combination of lower rates, pent-up demand from sponsors and trying to move some of the properties they've been sitting on since the pandemic. So you see this pent-up need. You're seeing the rate environment being more constructive. You see the uncertainty of the election slowing things down, but you see the pipeline moving slowly through the process, and therefore it portends to an active year in 2025.
Got to squeeze this in with 60 seconds left.
Yeah.
How's the housing market in Canada since we last spoke? What's it looking like?
The housing market's stable. Housing's driven by demand. Certainly construction is way off given interest rates, so people listing ratios are going up. You're seeing slow resale activity. You're seeing slow construction activity, but that demand, given the amount of immigration we have, pent-up demand, so you're still, Jonathan, in a situation of excess demand over supply. We are short 3 million houses in Canada. We're building roughly 250 to 300,000 houses a year. We have a 10-year backlog on supply, and we're more concerned about how fast we're going to build. Therefore, that lends to stability in prices over time, even when demand drops.
It's the time of the year where Americans start to threaten to move to Canada. You know where this goes. Dave, it's good to see you.
The weather's coming.
One half of the country, anyway. Dave McKay of RBC. Thank you, sir. Appreciate it. Coming up next on the programme, Gilles Moëc of AXA and Jitania Kandhari of Morgan Stanley Investment Management. With your equity market on the S&P 500 negative here by 1/3%. Bond yields pretty stable, lower by a single basis point on a 10-year after a sell-off yesterday. The smallest of rallies this morning, 418.57 on 10s. From New York, this is Bloomberg. Equities trading just a little bit softer over the last few days. Monday, touch lower. Tuesday, down by 0.4% on the S&P 500. On the Nasdaq, we're down about 0.5%. On the Russell, the small caps also down by 0.5%. With 1 hour to go until the opening bell, let's get you some morning movers and cross over to Manus Cranning. Morning, Manus.
Jonathan, very good morning to you. Mary Barra delivers a couple of key messages at GM today, which is, look, we're doing everything to stop the bleed in China. Yes, it's been 3 straight quarters of where we've lost money, but she reaffirms the guidance. It's about doing what we do best, which is building big old trucks and selling them, whether it's the GMC model, the Chevy Silverado. This is what they do. High margin products, reaffirming the margin, reaffirming the cash flow. EBIT for this year, $14 billion. And Dan Ives says, look, recovery has begun at the Detroit stalwart. I talked about cash flow up by 19% in the quarter. Again, it engenders the story of buyback. So this is Mary Barra really gripping the big issues at GM and delivering. Roll it forward and you have General Electric Aerospace aerospace. This stock was up 91% before today. So just put this a little bit in context for you. Yeah, they've lifted the guidance for the whole year. This is about their commercial engine business. This is about the overall structure that they have. But it is the infancy of independence for them. And the CEO, Larry Gulp, says we are in the midst of a heck of a year. Just think of the supply chain issues around a lot of the aerospace industry. And again, you begin to understand a little bit lighter on the sales number is what's knocking the stock this morning. I leave you with a thought from Kimberly-Clark. This is about Kleenex. This is about toilet rolls. You see, it gets very exciting when I come to do this hit for you. But this is about the sales outlook and the inventory build-up in the retail side. Procter & Gamble told you that the same issues just a few weeks ago. So I'll leave you with that salutary thought. I just want a GMC pickup truck to drive through those cobblestones in Soho. Jonathan, good morning.
Manus Cranny, appreciate it. Thank you, sir. Thanks for the update. Manus Cranny there. Seen that a few times. Manus mentioned it. Kimberly-Clark, P&G as well. Those consumer-facing companies not doing too well over the last few quarters.
I got to go back and check the stockpiling of toilet paper and figure out where that is in terms of the pros and cons. But it does raise some questions. How solid is the consumer, or is it still one sector of the consumer that is paring back and maybe only getting a certain brand that's cheaper than other? Although I honestly, that is one area that I've always actually...
Where's this going?
I always have shelled up for good toilet paper.
OK, thanks for sharing that. I'm not sure why you felt the need to share that with us this morning. The conversation wasn't going there, but thank you. Appreciate it. Let's turn to the bond market. 10-year yields look like this at the moment. You pull yourself together. We're down about a basis point, 4.19 on 10s. On a 2-year at the moment, just about stable, around 4%. Let's talk about the difference between Lisa and the rest of the world. No, let's talk about the difference between the US bond market and Europe. Gilles Moëc of AXA having this to say. The market is now almost exactly aligned with the FOMC's dot plot. Conversely, the same uncertainty doesn't exist in the Eurozone. It seems that investors have made up their mind. Let's get to Gilles for more. Gilles, investors making up their mind that the ECB is going to cut interest rates, and the ECB keeps saying the same thing. We are data dependent. We are meeting by meeting. Is the market in charge?
At the moment, it feels a bit like this, yes, because what's really interesting is that no matter what the ECB has been saying in the last month, basically, what the market has been expecting for what the ECB would do within the next 12 months has not moved really, and it moved by a few basis points, which tells you that markets came back from their holiday recess and started thinking, well, the European economy is not doing well at all at the moment. And inflation is, coming down much faster than what the ECB was expecting. So they're going to cut, and they're going to cut in a fairly steady but quick pace, I would say. So no matter what the ECB says about, we're going to take our time, we're going to look at the data, it's going to be one meeting at a time. Yes, I think that the market has made up its mind, and basically the sort of dovish shift that we had in terms of tone from Lagarde has basically confirmed this hint by the market.
We've talked about the European economy many a time together over the years. The word that I've used repeatedly over the years so far has been dreadful. There are varying degrees of dreadful whenever we talk about the European economy. Could you frame for our audience outside of Europe, here in the United States, how bad are things in the European economy? The PMI suggested in the last month things were pretty terrible. Are they that bad?
I would not use dreadful. I would use mediocre, which I think would describe it a bit better, in the sense that there is no real short-term risk of a proper recession, I would say, in the Eurozone. We're just hovering just above the flotation line. And there are some countries which are doing very well. Southern countries in general are doing okay, more than okay. Spain is doing very well. So we're having issues with the core of the Eurozone. Germany has been in and out of GDP contractions for basically 2 years. France is having its own problems. But yeah, I would describe this as mediocre, because I think the biggest issue we have is that although we have exactly the same dynamics as in the US in terms of wage growth being perfectly decent, outperforming inflation, so that should generate enough purchasing power gains to support consumer spending, it's not happening because people are saving too much. And that at the moment is the big difference between the US and Europe.
It raises a question about whether that's true in a policy perspective as well. In Washington, D.C., a lot of people are gathering to worry about the deficit. I'll be heading down to worry about the deficit with them. But there is a large question about whether the ECB and the central, just in general, the fiscal ministers of Europe should be more focused on reducing the deficit or more focused on trying to stimulate an economy that is kind of losing some of its levers of growth.
I don't think in any case, I don't think we have much of a choice here, in the sense that even if we're certainly out of all the pressure we had on the peripheral countries, and that's good, We had an experience in Europe not so long ago in the UK suggesting that if a country goes too fast into stimulus, the reaction from the market is actually quite quick and quite painful. We should never understate the impact that the Liz Truss episode had on European policymaking. It has really been used as a lesson. So I don't think there's much of a choice here. My view here is actually, if we're lucky, and I think we might just be lucky, there is this change of tone from the ECB. I think they are readier than a few months ago to provide really a good dollop of accommodation, and that could just offset the impact of the fiscal consolidation. So we should be able to stay just above the flotation line. But deep down, I think the biggest issue, and it's being lost a little bit in the policy conversation, is that Europe looks at the US, and at the moment what the lesson they draw is, okay, just pour billions of dollars into the system and it's going to do the trick. And obviously it helps. But if you look at the structural forces of the US economy of the last few years, you've had this significant acceleration in productivity. It has nothing to do with the IRA. This is the product of corporate choices, investment in R&D, investment in softwares that happened 10 years ago. And by being, I think, to some extent, a bit overly focused on the need for additional stimulus, we're losing, I think, the sense that if you build a sound and proper business environment for your corporate sector, you might actually get the kind of productivity gains that you've seen in the US. And we are completely at the moment focused on the billion pouring side of the equation. It helps, but it cannot be the entire story if you really want to lift potential growth in Europe. We still have sources of rigidity. 10, 15 years ago, it was obvious to everyone that we had to reform. And now we are talking less and less about reform, more and more about pouring billions. I think it's an interesting shift.
So put this together, because you're talking about how the Liz Truss moment kind of hangs over the ghost, the entire Euro region, which is a reason why there is so much focus on debt reduction, and yet you are seeing yields rise in tandem over the past few weeks, at least in the longer term, with the U.S. So do you believe that the divergence between the U.S. and Europe can truly grow, or do you think they're kind of tied at the hip because of these dueling priorities in Europe?
It can unfortunately grow because it's a bit the curse of European financial markets in the sense that there's always been this dominance of the US market. So if growth in the US remains as strong, if inflationary pressures in the US come back a little bit and we have long-term yields in the US coming up, there will be some contagion to European yields, even if honestly our proper fundamental situation is not consistent with higher long-term yields. And this has always been our problem. As long as the European financial market remains dominated by the signals coming from the US, we will always be at a disadvantage, basically. When the US is doing well, obviously that's good for our exports, but at the same time, it's usually detrimental to financial conditions in Europe. And we are a bit in this situation. Now, we should not overstate the case. I mean, we're talking about German yields staying between 2.25%, 2.5%. I mean, we can survive this. French yields 3%. We can survive this. I mean, it's not a situation which calls for alarm. But yes, normally we should be expecting even lower long-term yields. We're not having them. And yes, the situation in the US explains some of this resistance.
Can European exporters sustain a 10% tariff ring around the United States?
I would define this as unpleasant, but probably manageable. I mean, there would be a cost to GDP growth in Europe. That's obvious, but it probably be, there are different estimates, maybe 0.3%, 0.4% of GDP. It's manageable. The biggest issue for me is the knock-on effect from a 60% tariff on Chinese products for two reasons. One, because you could have a very detrimental impact on Chinese demand itself, which would have a knock-on effect on our exports. And second, it may incentivize Chinese exporters to try to focus on the European market or to try to compete even harder with our products on third markets. If you throw into the mix the fact that one possible reaction of China to a 60% tariff would be to allow its currency to fall faster, then we end up at disadvantage yet again, because you would end up with an appreciation of the euro relative to the yuan. So it's the 10%. Obviously, everyone talks about it. But I really think the biggest issue is this 60% on China.
Everything you just said screams disinflationary shock on the continent. Like, screams it, doesn't it?
It's
each and every one of those 3 points.
It's interesting how the debate has moved from inflation is too high to, oh, inflation may undershoot. And I think it explains this change of tone from the ECB in the last few weeks. I think there is the sense, for instance, if you look at the list of arguments, the list of upside risks to inflation, 1-2 months ago, they were, for instance, talking about trade disruptions, aka trade tariffs, as, oh, it could be a source of inflation. And now it's about, oh no, it could actually be a negative impact on demand, and that would actually be disinflationary in Europe. So, yes, this is aligning. The debate is changing in Europe, which is the reason why I think the ECB is really going to probably cut 25 bips every meeting until the middle of next year.
Gilles, appreciate it. Smart as always. Thank you, sir. Gilles Moëc there of AXA. The 3 points that Gilles makes there, I think the number one point is that we have overcapacity in China. We know they're exporting that overcapacity to the world. And if the walls go up in America, Europe's got to eat it. That's a major disinflationary shock. The additional points that Gilles is making, the currency channel, one. And the other one, ultimately, the Europeans won't have a big source of demand, China, because they'll be weaker off the back of it. Again, just feeding into that disinflationary narrative.
Which is, to Gilles' point, the reason why maybe the ECB is going to change its tone and has been so behind the curve. Still, the focus has been on combating inflation. But if the worry is not having inflation that's high enough, well, that kind of changes the trajectory for potential rate cuts.
The euro right now, 108.16, just about unchanged. It was kind of rolling over as Gilles was speaking for obvious reasons, obviously, with the ECB cutting interest rates 25 basis points at every meeting for the foreseeable future. Let's talk about the bond market just briefly. A 2-year, 10-year and 30-year shaping up as follows. Big move higher worldwide. And I think that's a really important point that we've got to make this morning. This wasn't just a US move, it was a global move. You can say it started in America with that double-digit move on a 10-year at 418.38, but we saw it in Germany too. Similar size move, saw it in Australia as well. 16 basis point move, Bramo, on a 10-year in Australia just overnight.
Well, this to me is fascinating because what you're looking at is essentially a global bond market, and Gilles was talking to this too, that really Europe is going to be subjected on some level to whatever happens in the U.S. if yields go higher, even if they're facing disinflation. So how much of a drag is that? How much can you actually see that divergence widen?
Back with us around a table, joining us right now, Jitania Kandhari of Morgan Stanley Investment Management. Jitania, good to see you.
Good to see you.
Welcome back to the programme. Over the last few months, we had one conversation and it's changed very quickly. So I'll go back to what the conversation sounded like maybe a few months ago. Yields were peaking, rates had to, and growth was going to start to decelerate. Now, all of a sudden, a few months later, we've turned that on its head all over again. Where are we now?
Yeah, so I think at this point, we are discounting the Trump trade, right, with inflation picking up, yields picking up. But I think I'd offer 3 perspectives that is a little different from what the market is saying today. One is when Trump came in power in 2017. That was a big surprise. Today, there is a 50% chance that he comes. So the reset post the elections is going to be less than what we saw in 2017. Second, with all this inflation getting discounted in the market, it's important to note that despite all the Trump tariffs since 2017, the export prices coming out of China are the lowest compared to any other market. So yes, there is excess capacity, there is an adjustment mechanism there, and so I think that's important to keep in mind. And the last thing I'd say is, even when tariffs were imposed on Japan in the 1980s and 90s for pretty similar reasons, which is automobiles and semiconductors, the yen took the brunt of that adjustment to offset the tariffs. So I think you have to kind of read outside of the obvious and what the consensus is thinking. So we are not really positioning one way or the other. But to your point, yes, growth has been much more resilient than people expected.
You said you're not positioning one way or another, but are you looking for dislocations that could emerge on the heels or ahead of the election that could be good entry points or selling points for overall theses that you have that are independent of the election?
Absolutely. So we're really studying all the impacts of the policies. One is, how does the deficit get funded between the two presidencies? One is through tariffs, the other is through taxes. So trying to understand that landscape. But it's still within the margin of error in terms of the 50-50 chance of who comes. So it's just being very nimble, the ability to act. And I think the biggest transmission from an asset allocation perspective is clearly how this manifests in the dollar and how that view translates into US versus ex-US, because the dollar kind of impacts a lot of the international markets. So definitely keeping all the outcomes in mind to kind of act, but not positioning one way or the other.
So when you look at the outcomes for the dollar, it looks like the dollar's higher under both, at least in the short term. But what about the long term?
So long term, we talked about this last time, that the dollar is expensive. But the dollar is not an emerging market currency that moves up and down 30% at one shot. So it moves within a 10 to 15% band if you look at it. So you could pretty much have counter trend rallies in the US dollar, and the growth differentials and rate differentials in the shorter term determine that. That seems to be now favoring the dollar, but the longer term path is an international allocation given the expensive dollar view that we've had.
So you're advocating for a bigger allocation to EM equities. Is that fair?
I think we're looking at pockets of the world, international and EM. I mean, just an interesting point here. So the market cap of Apple today is larger than the entire market cap of UK. Or, there are these market cap of NVIDIA larger than Australia, right? The market cap of the Mega 7 is larger than the entire European market. So there are dislocations in the financial ecosystem that we are trying to, capture, and we're trying to be invested in. And yes, some part of it is in emerging markets, some part of it is in pockets of Europe, Canada, Japan. So we have a pretty wide spectrum of allocations across different countries.
You used a word that was important. You said dislocation. Some people might say it's just a fundamental rationale. The FTSE 100, not even 1% of it is information technology. 20% of it, as you know, is financials. Some people might say it makes a heck of a lot of sense that we see these big companies in America and we see these small market caps elsewhere across Europe. Why is that a dislocation?
Because I think the focus is so much on the Mega 7 and following the trend there that a lot of these different pockets of the markets are beginning to see some fundamental momentum. So if you look at even things like the industrial pockets of Europe, the domestic side of UK looks really interesting to us, given where we are in the economic cycle, in the monetary policy cycle, and also the fact that a lot has been discounted in the UK markets post the whole Brexit issues. So several pockets of the markets are dislocated, but also have a fundamental driver to unlock and to catalyze a move in those pockets across the world.
Thoughtful stuff. It's good to hear from you, as always. Thank you. Jitania Kandhari there of Morgan Stanley Investment Management. Just to get you up to speed on the equity market, we rolled over just a touch going into the opening bow. That opening bow is about 41 minutes away. Equity futures down here by 0.5%. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. A federal ban has gone into effect, which prohibits the sale or purchase of online reviews. The FTC under Lina Khan issued the rule in August, but the agency can now seek civil penalties against those who knowingly violate it. The rule specifically bans reviews and testimonials from people who don't exist or are AI, people who have not engaged with the business or product, and those who misrepresent their experience. Elon Musk and Tesla are being sued by Alcon Entertainment. The studio says Tesla used imagery inspired by the 2017 movie Blade Runner 2049 at its recent robotaxi event after permission was denied. Alcon also alleges that Tesla didn't reach out for permission until the day of the event. Musk, Tesla, and Warner Brothers Discovery, which hosted the event, are all listed as defendants. The Nike swoosh will remain a fixture on pro basketball courts for years to come. Nike reviewed its partnership with the NBA and WNBA to serve as the league's uniform and merchandise provider until 2037. Nike will oversee the design and manufacturing process for both fans and players' apparel. Financial details of that deal have not yet been disclosed. And that's your brief. John.
Danny, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. From New York City, you're watching Bloomberg TV. "36 minutes away from the opening bell, equity futures near session lows were down by 0.5% on the S&P 500. In the bond market, pretty stable after yesterday's sell-off. 418.97 on 10s after breaching 420 to kick off a trading week. As we count you down to the opening bell, here's the trading diary of the week ahead. It's shaping up as follows. 10 a.m. Eastern Time. Bloomberg's Francine Lacqua sitting down with the ECB President Christine Lagarde. Do not miss that conversation on Bloomberg TV. Tomorrow, Tesla and Boeing report, plus the Fed's Beige Book coming at 2 p.m. Eastern Time. Thursday, another round of jobless claims, plus S&P Global PMIs. And we'll also get earnings from UPS, Southwest and American Airlines. And on Friday, durable goods and UMich sentiment. About 90 seconds left. Enough time for a final word. Final word, Bramo.
I want to see actually some of the earnings, in particular with UPS, because that used to be a bellwether. Yes, you do have competition from the likes of FedEx, but the earnings are going to get more and more interesting at a time where the other data is messy. And I think at a time where people are talking about no landing, hard landing, soft landing, and confused about the election, I want to hear what the company executives have to say.
Well, I want to see more confusion about the election. Kamala Harris is sitting down with Telemundo and NBC. Former President Donald Trump's in Miami and North Carolina today. It's the final push now. What are the latest promises going to be 14 days out?
I'm looking forward to the bonus edition of the podcast of this program where Lisa will tell you more about her toilet paper preferences.
Well, I think
that'll be released a little bit later this afternoon.
I think that a lot of people would agree. I think that there are small luxuries in life that you can go for, even if you're a student, and that was one of them for me.
Okay, just to clarify, there will be no bonus parts of the Bloomberg Surveillance podcast a little bit later. Coming up tomorrow, we'll catch up with Ben Gutteridge of Invesco, Alicia Levine of BNY Wealth. We'll speak to Senator Tom Tillis of North Carolina, and Francis Donald has a new seat. Looking forward to this. Congratulations to Francis Donald of RBC joining us tomorrow morning. Look out for that. Equity session lows on the S&P after a big sell-off to start the trading week in the bond market. Just a little bit of stability. Your 10-year at 419. Your 2-year just holding on to a 4 handle. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.